All right, folks, so we're just going to get started right now. I know it's at 7:25 and it's 7:20, but let's get into it, dude. We got some good numbers. We got some good numbers in the world of SoFi. Good morning, good morning, good morning. Thank you, everybody, for being here. It is time to begin and discuss what's happening in the world of SoFi. And these numbers do not look bad. These numbers do not look bad at all. Good morning to everybody. So SoFi, that's what we're going to start off with. We have a lot of stuff to talk about today. Tesla has some crazy news. Tesla right now is $183 in the pre-market. It's up basically 25% in the past 2 weeks from the bottoms of 140. And the reason it's up is because they made some big announcements in regards to launching FSD in China. So we'll talk more about that later. But let me bring up the numbers when it comes to SoFi. So the top headline numbers, the stock is up about 6% right now in the pre-markets. Headline numbers, $645 million of revenue. That's pretty incredible. The street was expecting a little bit less than that. 2 cents a share, so they beat earnings by 100%. The street was expecting 1 cent a share. And then 622,000 new members added. I thought they would come in at about 582, so they beat on the member growth expectations pretty well also. That is what we got in this quarter when it comes to SoFi. Let's pull up the stock real quick and see what we're looking at right now, just to get an understanding of what's going on there. Let me pull this up. Present stocks. It's not struggling a little bit, but it's definitely not bursting out like crazy. And I think the price action during the day is what's going to be important to see if the stock can actually maintain some of its pump that we're getting right now. And that's going to be very, very important. Okay, can you guys see this? Yes, you should be able to see this. We should be good. SoFi. There you go. Yep, you should be. So 821 right now in the pre-markets, up 4.32%. Not bad at all. 8.32% is not bad. Obviously, I think we all want to see a rally to probably the 9s today to really solidify that we're getting some momentum here. But we're going to have to see if that can be possible. There's your green candle right there. Fell from about 784 in the pre-markets up to 846. So we got past that 830 level. And now we're here at 821 trying to see if we can get a little bit higher. Do you think we'll see more momentum when the market opens? Manuel asks, yes. I think these numbers are good enough to justify that momentum. I think it would be very weird if it gets sold off. And we'll go about the numbers in a second. We'll have the call at 8 a.m. So we'll hear from Noto and the team at 8 a.m. And I have some things I think they need to say on the call to make sure the shorts actually cover their position, which could explode this today. But Tesla as well, 183. Tesla's up 10%. Tesla's up 10%. And the reason Tesla's up 10% is because they just announced a partnership with Baidu, which is basically the Google of China, to be able to partner to do the data mapping that it takes to basically track all the roads in China and then be able to navigate all the roads in China via FSD. That's a big deal. China wins because they get a Chinese company that gets part of the data. They get part of the, I'm assuming, share of the revenue, right? Whatever it may be. And then Tesla obviously wins because FSD is basically 85% margin on every 15,000, 12,000 that they charge, 8,000. And if the Chinese consumer can't afford it, Tesla gets to print money from a very competitive ecosystem in China where car sales are already down. 25% of sales of Tesla are in China. BYD has been competition, so FSD can be a key differentiator. And working with a Chinese company like Baidu that has all the data around China, kind of like the Google Earth of China, right? Google Maps of China. That's very valuable. So Tesla right now up 9%. We'll talk more about them later, but SoFi right here up 2.67% in the pre-market. Again, not really breaking out the way we want it to break out in this 808 range, but I think Noto on the call will announce enough to get this to keep going. Good morning, Amit Oak. Good morning for being here. Thank you all for being here, and good morning to everybody. Let me pull up their numbers, and let's see if these guys have numbers that are exciting enough. Well, the numbers are exciting enough based on what I'm seeing, but let's pull up the actual deck, and we'll go through it slide by slide. If you're just joining, SoFi put up some really good numbers. They put up some numbers. Those numbers deserve to get, I would say, a pump to at least $9 today, and we'll see. Noto has to talk about something during this call that makes the shorts scared. And if he does, then I think we're going to get an exciting earnings. If he doesn't, then we'll see how the street reacts. Maxime, thank you for being here. Says, love you, Amit. Love you too. Thank you for being here on the stream. Bay Ray, what's up? Thank you for being here. I'm Beneficial. What's up? Otto, what's up? Lisa, Brad. All right, let's get into it. So here we go. 622,000 members. This is up 44% year over year. SoFi now has 8 million members. SoFi now has 8 million members officially. 8 million members is no joke, dude. 8 million members is a lot of members. And one of the reasons, or one of the things that's exciting about SoFi having these many members is that their core sort of key businesses that they can upsell these members in a variety of different ways once they get them. The NBA partnership, I actually think has been pretty good for SoFi. As I've been watching a couple NBA games, given its playoff season, I do see their logo all over the courts. And in terms of unaided brand awareness, meaning people that just see it and want to Google it and see what it is, I'm sure that's bringing in more momentum for SoFi. So that's great that we're seeing that right there. Basically, that year-over-year growth has been in the 40% range for the past 4 quarters, which is good. I mean, it's going to be hard to keep that at 40% over the coming years. So the fact that that's staying there every quarter for the past basically 2 years is incredible. Products. 989,000, bringing the total to 11.8 million. So the products are basically just loans, different things, mortgages, whatever people take out in the context of SoFi. 11.83 million, 981,000 in Q1, 38% year over year. That's a little bit lower than what we had the past few quarters, but again, that number will slow down as SoFi becomes more of a mature company. So not bad to see SoFi progressing there. Galileo, this is what we're really looking for in terms of the tech platform. 151 million accounts are now using the backend payments B2B infrastructure that is Galileo. For me, this is the main thing I care about today. I think if Noto can announce a partnership or an announcement or something exciting in regards to the tech platform when this earnings call starts, the street's going to be excited. Right now, we have total accounts at 151 million, up 20% year over year. If Galileo can truly start to grow, as you can see, in 2022, it was growing 60% every quarter. Now it's growing 10% every quarter. That's not bad, but there is a major change right here, 11% to 20% from Q4 to Q1. That is a reacceleration. That should be enough to get the stock to go up. That should be enough. I mean, like from here, it went down year over year from Q1 to Q2 last year, 15% to 11%. And we had a bad macro, so you could expect the stock to get hit. But now we're seeing a nice reacceleration back into the high double digits, at least in the 20% range. So I would expect that to be something the street cares about, especially if they want to value SoFi outside of it just being a bank and being more of a fintech, which means Galileo is definitely something that's important to see. Matt says Tesla's up 9%. Correct, Matt. Tesla's up 9%. They announced a partnership in China with Chinese company Baidu, essentially the Google of China, to do the data mapping and architecture for FSD. FSD is coming to China. That's what it looks like based on the Bloomberg article today. Elon was in China over the weekend, and the stock is definitely signaling that they're coming to China. And what's going to be so funny, we'll talk more about Tesla later, is if retail was buying from 138 to basically today 180, and the street wasn't, and we know the street wasn't, right? They were downgrading. And the street has to chase at 180 or 190. Oh my goodness. What a beautiful story it'll be. Tesla's up 12.8%. What a beautiful story it'll be to see the street have to chase something that retail got right again in the context of Tesla. It would just be beautiful. Tesla right now, 185. Wow. 185. There you go. 185 for Tesla. Yeah, there you go. It just switched screens. 185.52 up 10.29%. Absolutely incredible. We'll talk more about Tesla, but that's incredible. Okay, so next thing, lending and financial service products. We have lending up 20% year over year, and we have financial service up 42% year over year to 10.1 million. Lending's at 1.7 billion. Good growth across the board. Financial services, this is what we really want to see continue to grow, and that's growing as well. So again, no red flags on this earnings at all. At least not what I'm seeing. Maybe I haven't dug as deep into it. But look, the biggest red flag every SoFi quarter for the past 2 years was they're not profitable. They beat on EPS by 100%. Like, this is one of those quarters where if the damn stock doesn't reflect the momentum at this point, I don't know what they're going to... Yeah, stock's under $8 right now. Let's see. Let's give it some time. Stock is under $8. It's getting sold off. But everything, that you could expect SoFi to pull off, they pulled off right here. So this is their productivity loop. They include this every quarter, basically just showing how many people join from how many different types of products they offer. That's fine. Net revenue, 581 million. Overall revenue was 645 million, 26% year-over-year growth. Adjusted EBITDA, 144. Again, they made $88 million in profits. Not bad. That's kind of what we all expected, actually less than that, right? We expected like 40 million, so that's not bad at all. We expect to deliver 565 million in adjusted net revenue next quarter. Interesting. Maybe this is why the stock's down a little bit. They're expecting to only put up 10 million in profits next quarter. I think this is why it's selling off. They're expecting to do 10 million in profits in Q2. They just did 88 million this quarter. I hope I'm not reading that wrong. And I hope that's, yeah, that might be why the stock's a little iffy right now, guys. If they're only going to do, like, they just did 88 million this quarter, which is amazing, but that's going to decrease to 10 million next quarter. Now, maybe that 88 million is only because of, look, maybe is that 88 million only because of the convertible note deal they did? We'll read from the press release in a second. Sandbagging. Yeah, but sandbagging by 70 million, dude, that's a lot of sandbagging. Like, that's I don't know. Maybe the street already knew that, and that's not big of a deal. Maybe I'm reading too much into that, but that's a little okay. We'll talk about that. Financial services net revenue growth of more than 75%. We know that. Tech platform growth of 20%. Adjusted EBITDA of 590 to 560 million. Total CAPA ratio over 16%. That's good. 800 million to 1 billion tangible value growth. This guidance assumes expenses under the EBITDA line to remain flat. Full year 2024 guidance, they are expecting about 2.4 billion in revenue on the high side, which is 17% growth. Huh. Yeah. Yeah, so interesting. So this is, I think this is why the stock is struggling right now. If I had to make this announcement, or if I had to like analyze this. So revenue growth for the past 3 years, as you can see, is 63, 52, 35, right? Pretty high growth tech numbers. Revenue growth for 2024 is 15 to 17%. That's not even 20%. Now we know it was 14 to 16% last time, but still, they're increasing it. But you know, it is still lower than what. Again, this goes back to the conversation of SoFi is just a bank, right? And the bulls will say, well, it's a fast growing bank. Yeah, but if it's only growing 15% year over year, it's growing faster than some of the other banks, but it's not growing at 35, 45, 50% year over year growth, right? So that might be one of the reasons why it's in a tough situation. Adjusted EBITDA margin is up. That's fine. The street doesn't care that much about that. GAAP net income, they're saying 165 to 175 million. They adjusted that from 95 to 105 million. So they did 88 million this quarter. They're going to do 10 million the next quarter, which means the last quarter, I'm imagining maybe 20 or 30 million. That's also why the street's probably like not that excited, because they're only going to bring in about $200 million of profits, right? I mean, like, that's not that exciting right there. And then diluted APS 9 cents a share, tangible book value growth up to $1 billion. It's not bad. It's just SoFi right now, 798. I think these numbers right here are the reason why the street might not be super excited. It's that 15% year over year growth, 165 million in profits. They already did 88 million right now, and then 9 cents a share. Now, granted, I still think that's enough to get to $10. Like, I don't think that's like we have to be stuck, in purgatory at $7. That's just like stupid in my opinion. And I do think my argument is $12 by the end of the year. I think is very possible, but I think that's what the street is struggling with right now. I think that's what it's struggling with now. Shorts trying to cover. I mean, we'll see. Right now, it's only up 1.27%. I think as the market opens, we'll see if the shorts really cover. But let's see how that plays out. All right, so what did Noto say? Our first quarter was an exceptionally strong start to 2024, demonstrating significant momentum as we responsibly grew revenue and diversify our financial services and tech platform segments to sustain profitability, reinforce our balance sheet, and grow our member base. We delivered adjusted net revenue of 581 million, representing 26% year-over-year growth. Financial services and tech platform segment revenue grew 54% and represented a record 42% of consolidated net revenue. That's good. Financial services and tech platform being 42% of revenue. The problem is the guidance on the revenue, I don't think reflects that growth, right? Or like makes that growth pop out as much as it was. Because if financial services and the tech was 42% of adjusted net revenue, if their guidance was like 25% in terms of the CAGR on the year-over-year growth, then I think the street would get much more excited, but it's only 15%. Offsetting flat lending segment revenue given a more conservative approach in light of macroeconomic uncertainty. Okay. Noto also said, we opportunistically executed 2 key transactions in the quarter. First, we issued 862 million of convertible notes due in 2029 at a 1.25% coupon to reduce overall financing costs. Second, we exchanged 600 million of principal of our convertible notes due to 2026 SoFi common shares at a notable par discount. This is basically all he talked about before. Their capital ratios are 15.3%, which is comfortably above the minimum of 10.5% from regulations, which is fine. But again, that's not enough to, I think, move the stock that much higher, at least right now. The street basically knew all that. Total deposits grew by a record 3 billion. So this part is actually concerning to me. I'm not going to lie. I think deposits are relatively low compared to the members they're getting. So that's up 16%, which is fine. But you would think that there'd be more deposits coming in. That one to me is not like the coolest number to see. They have 21.6 billion at quarter end, with over 90% of SoFi money deposits coming from direct deposit. And with direct deposit, you would imagine it's even more because they get people that make a lot of money, right? Doctors, lawyers, high FICO score, 744 average. So 3 billion, it makes me think that how many people are, I wish they disclose how many people are actually using direct money deposit, because they have 8 million members. But if it's only like 800,000 that are using the direct money deposit, which I would imagine is no way, that's too low. I feel like it should be way more than 3 billion, to be honest. Okay, the tech platform revenue growth accelerated 21% year over year. Contribution margins went from 19% to 33%. That's amazing. Those are up 73% in a year. That's incredible. And then in lending, a record 82% of these segments adjusted net revenue was derived from net interest income, compared to 62% 2 years ago, which is actually very good. It doubled basically since they launched SoFi Bank, and that shows that they have strong performance in their balance sheet assets if their net interest income in lending is double than it was in 2022, which is really good. These are all good numbers. These aren't horrible numbers. I don't know if they're blowout numbers to get the stock to the next level. Tesla right now up 10%, SoFi 1.4% currently. Yeah, again, I think that's the big thing is their net income guidance is not that substantially better. And when you know what the net income is going to be, it's very easy to create a multiple, right? Like, it's not that hard to be able to decide what the multiple ultimately will end up being. And the street has pretty much known what the numbers are going to look like for a while. So I think that's what we're struggling with right now. But Amit, Russia just approved a seizure of 500 million euros a week from JP Morgan. Yeah, I heard about this. Russia's going to do whatever Russia wants to do. I mean, like JP Morgan, I don't even know if they operate that deeply now in Russia. Most companies left from Russia. 14 to 16% is bad. Yeah, that's the one thing, dude. So when I talk to a lot of SoFi bulls, the argument is, yeah, it shouldn't be valued as a bank because it's growing faster than a bank. But if they're only growing 15% year over year, what's JP Morgan's growth rate? JP Morgan revenue growth rate. Is it like 3%? It's 8%. Wow. It's 8%. I mean, like they're growing double JP Morgan. Or sorry, so December 2023 was 11%. That's actually higher. That means they're growing about 40% higher than JP Morgan. And JP Morgan's way more profitable, right? This is the bigger problem I see with SoFi. Again, I am bullish. I think it can do well. I think the tech platform really needs to accelerate. But right now, the reason we're seeing the stock not really take off is because the growth isn't as substantial as I guess we thought it could become. Up 1.52%. It's still up. It's still green. But I could see this turning red very easily, quite frankly. I could when the market opens. Unless Noto gets on this call and he says, you guys are stupid for not buying SoFi. If that could happen, that would be exciting. Noto will create excitement and a bump, and then it will fall back down as usual. Yeah, and see, the problem is, like, I'm thinking about the rest of the year. What gets this thing to go above? Like rate cuts, maybe. But then it would just pump with the macro, and that pump is not sustainable. I'm thinking, what is a company-specific thing that can get it to pump? And I don't know. Like, guys, just in general, 3 billion in deposits to me is not super exciting. Tesla right now at 186. 3 billion in deposits is like, it's kind of weird, dude. 3 billion deposits is not a lot. That's $1 billion a month. I feel like they should be getting way more money than that, especially if they have everyone's direct deposits. That means they take your money from your job. That should be substantially higher if they have 8 million members. There's no way 8 million people are using direct deposit. There's just no way. There's no way, even though 90% of the deposits come from direct deposits. But if you had 8 million people depositing every single month, I feel like that would be way more than 3 billion. The past ER calls, they have hinted at a major financial institution as a tech contract. Yes, I think that's the thing Noto needs to talk about. If he says something like that, maybe this thing really pumps up to $9. If he doesn't, then it's going to be in a little bit of a tough situation. Younger client base. That's a good point, Tom. Younger client base. Yeah, that's a great point. Now, granted, their client base is still in the high earners, or at least that's what they say they are. Palantir as well, 2294. So theoretically, that should help, right? But that is a good point if they're younger. So we got Palantir 2294 up 1.87%. I think Palantir's up honestly because the market's pumping a little bit in the context of AI. Nvidia, where is Nvidia right now? Nvidia was on 60 Minutes. I don't know if you guys saw that last night. I would play the clip, but CBS is so like like authoritarian about playing their content on YouTube, so they wouldn't let me. But Nvidia right here, 877 right now in the pre-markets, of 0.06%, which is not bad at all for Nvidia. They were on 60 Minutes yesterday, and Jensen basically talked about how GPUs are taking over the world. This is a nice little picture. Let me show you guys of Jensen at Denny's casually. I think Nvidia is going to crush earnings, dude. He's being very casual, sitting at Denny's, just chilling. Like you would imagine that they're going to have a good job. Microsoft and Google killed it last week. That's also really good for Palantir. It's in the AI space. And this week, we're going to have a heavy week on earnings as well. So there's Jensen sitting at Denny's, just chilling out. Deposits better than most banks in this macro. Yeah, that's fair. That is fair for SoFi. Deposits are definitely better. So there's Jensen right here. All right, so we will have the SoFi call in 20 minutes. Let's talk about some other stuff going on right now in the world. For those that are just joining, SoFi did crush earnings, in my opinion. Stock's not reflecting it yet. And at the bell, we're going to see, after the call, if Noto can really get the street to get excited. I'm sure he'll be doing the rounds on CNBC and Bloomberg today. Again, the question is, will the shorts finally cover? And based on this earnings, dude, just honestly, there's not a ton to get excited for the shorts to be like, oh my God, we have to cover my position. Like if I was a short, I would just be like, I would leave it, quite frankly. I wouldn't be like, oh, I have to cover this right now. But if Noto is something that we don't know, I think maybe that could get us there, and that could be exciting. So we'll see. We'll see. I do think SoFi has potential to get back to $10 today. I know it's crazy, but I think the momentum is there. The volume on the stock is already 1.47 million. Market cap's 8.3 billion. We know how heavy retail is into SoFi. So if they buy it up, that can get the pump. The question is just, can we get that pump today? And we're going to have to see. And maybe it takes a couple of days. Maybe it doesn't happen today. Maybe it comes in the next few days. But usually SoFi pumps on the first day. And that's what gives us, that's what lets us know what happens. All right, let's talk about Tesla, and let's talk about the Bloomberg Tesla news right now. So this Bloomberg article today, absolutely incredible in the context of what's going on with Tesla. So let's pull this up right here. And then in 20 minutes, we'll listen to the call and see what Noto has to say. Why is Tesla pumping? All right, we're going to talk about that right now and discuss who bought Tesla on the dip. Put in the chat, who bought Tesla on the dippy dip? Because if you did, you are being heavily rewarded today. Let me pull this up. Okay, I think is this Reed? Oh yeah, we got Dan Ives here. Okay, so here we go. Let's listen to Dan Ives on Bloomberg, and then we'll talk about what actually happened. Here we go. This Elon went to China this week or this weekend. Here's what Dan Ives has to say.
Now that it wasn't perception-wise last week.
Well, it's a watershed moment because Musk doesn't just make this trip just to do it. Because if this could open up FSD in China, which I view as unlocking what could be really the golden opportunity for them when it comes to FSD and autonomous in China, which has been a missing piece in the puzzle.
Well, Dan, Steve Engel here. Let me jump in and ask. There's no doubt that Tesla needs China. With Elon Musk making that surprise visit. But does China need FSD? I was at the auto show. I saw all these new range of EVs. I hadn't been back to the auto show in 4 years because of COVID, and the technology has rapidly improved here, where a lot of these technology companies, whether it's Xiaomi or Huawei or others, are into this space. I'm going to go later today in Daxian District and get a test drive of autonomous robo taxis by Pony AI and Toyota. Does China need FSD from Tesla?
Well, look, Musk, most followed person probably in the world, and Tesla, I view as a trophy case for Beijing, and that's why Musk is there, because despite what we've seen in terms of just the massive competition domestically and so impressive from BYD and others, China needs Tesla just like Tesla needs China. And I think this is an important visit, especially in what I believe will be a rebound in China for Tesla. But FSD, that's the golden goose. That's what Musk is going after here.
So for those that are just joining, the news that broke overnight is that Elon's quick visit to China paid immediate dividends, with Tesla receiving in-principle approval from government officials to deploy its driver assistance system in the world's biggest auto market. So it's not literal FSD, but it's the framework and the steps for FSD to become real in one of the world's biggest economies and in one of the world's most dynamic economies that's really begging for more new technology to be prevalent in the region, which is China. Tesla was granted approval under certain conditions, according to a person with knowledge of the matter who asked not to be identified. Tesla did manage to clear two of the most important hurdles, reaching a mapping and navigation deal with Chinese tech giant Baidu, that is the Google of China, and meeting requirements for how it handles data security and privacy issues. Now, here's the thing that I was thinking about this morning as soon as I read this. When I read that Tesla was partnering with Baidu, immediately I felt, oh my God, there's so much data that's at risk of being shared with the Chinese government, right? Because China owns a part of Baidu, right? The CCP owns a part of everything. We're seeing all this stuff going on with TikTok. So I got scared when I saw this partnership. Then I realized, wait a second, it's China. This is Chinese people's data. This is not American data. So from my understanding, Tesla collecting the FSD miles that they're collecting in China. So let's say you have 1 million Teslas on the road in China and they're collecting all this footage and it's training the neural network, et cetera. That has nothing to do with America. That has nothing to do with American citizens, and that has nothing to do with the Tesla part of America, Europe, Australia, et cetera. That has everything to do with China's version of Tesla's FSD. So even though they're partnering with a company that is basically, in congruence with the CCP, because Baidu is the search engine. So if the CCP does not want you to search up, anything going on with free speech in Hong Kong, they'll just tell Baidu, hey, censor these results, and Baidu will oblige. That is not going to affect Americans. So I really don't think this matters for Americans. This isn't like a TikTok type of scenario. This is Tesla in China working with a Chinese company for Chinese citizens and FSD. And FSD in America is going to be, I don't think that data would necessarily be going into the CCP because it doesn't need to. And also it wouldn't be valuable. The FSD we get from America is not going to be valuable in the FSD that we get in China, right? Because totally different roads, bridges, all that stuff. So it makes sense. Tesla rose 9.9%. Baidu jumped 2.4% in Hong Kong. Tesla didn't respond for comment. The developments came after Tesla chief executive Elon Musk made an unannounced trip to China on Sunday. He canceled his trip in India. This was probably the reason. He probably had to do some more traveling to China, seeking approval for driver assistance software that could help arrest the car maker's revenue decline. While the company's suite of features require constant supervision and don't make Tesla autonomous, the company charges $8,000 for them in the US or $99 a month for a subscription. Even if they charge half of that in China, if they're making more revenue across the world, that is 85% margin. I mean, that's all that matters, right? So here's Tesla with Chinese Premier Li Qiang in Beijing yesterday, April 28th. That's why Tesla is pumping. What's up, Sachin, in the chat? Why is SoFi not $9 yet? Okay, so Sachin, let me know if you agree with this. Sachin publicly has a decent SoFi position. Sachin, the reason I think SoFi is not $9 yet is because the guidance right here, let me share this tab. The guidance right here is, I think, what the street doesn't like. I'm just guessing, but this is my hypothesis. This guidance is 15 to 17%, and the net income is going to be $10 million next quarter. They had 88 million this quarter. So I think the street's kind of looking at the net income and saying, okay, you did the convertible note deal, which is why you pumped up your net income in Q1. But in Q2, you're telling us on the high side, you're going to bring in 10 million of income, net income. And then you're only going to grow maybe 17% year over year. And even if they're sandbagging, I think they only sandbag up to 20%. Now, granted, the stock should still be $10 minimum, even with these numbers. But it's been so depressed at $8. I don't know if that's enough to get it to pump back to $10. Sachin says the guidance is weak for next quarter because this quarter has a one-time payment off 59 million. Yes, well, I think that's the problem, right? The numbers look really good this quarter from a net income perspective, but when you take away some of the like essentially financial engineering, it goes back to like not the most exciting numbers. I think that's why the street is not giving it momentum. So that's my hypothesis. We'll see when the market opens. I wouldn't be surprised if this goes red, but I also wouldn't be surprised if it pumps to 9. And I think a pump to 9 is very possible. It's just a question of, if there's momentum to buy it there. So we'll see. The problem is if it doesn't pump today, I don't know when it's going to pump because I don't know what news SoFi is going to have to put out at this point to get it to go higher. It's going to have to be something with the B2B tech platform. And if that thing just doesn't grow, then it's just going to be valued as a bank. That it is what it is. We have to accept that. And I guess we'll see. I think the numbers are great enough, though. The numbers are great enough this quarter to do what it needs to do. But let's see what they say on the call. Reading a little bit more from this article for why Tesla's up. Sachin says, while the revenue growth is lower than expected, we need to also acknowledge that the company is GAAP profitable for 2 quarters now, and this is where institutions jump in, as the next quarter are also expected to be GAAP profitable. Yeah, that's fair. That is fair. It's a fair point. Institutions should get more excited as the company is more GAAP profitable, and it will continue to be GAAP profitable. Reading from the Bloomberg article, advanced driver assistance systems are being increasingly common in China, with many local players, including Xpeng and Xiaomi Corp, using them as a selling point for vehicles. Car makers have also had success in charging extra for driver assist features, which Tesla could use after having cut prices to levels that may have been wiped out. Am I frozen right now on the screen? You guys can hear me? Yeah, you guys can hear me, but I'm frozen. Hold on. Give it a second. Yeah, this is, give me 1 second. It'll probably, it's probably that the screen's either going to go black or the thing will finally cancel out, and you guys will get to see me again. All right, I'm back. I'm sorry. I don't know why it's being stupid, but I'm here. We should be good. Douglas says, you're assuming we want to see you in the first place. Thanks, Douglas. I appreciate that. Thanks for being here. We're good. Okay, so let me go back to that article. The core thesis of this article is that basically there is not enough of there's not a real mass system in the context of Tesla. Or FSD in Tesla, or any type of system like FSD in Tesla. And that's why it's getting really excited right here. Approval for FSD in China would be a major boost for the company, which is coming off its first year-over-year decline in quarterly revenue since 2020. Even after slashing prices, the company sold fewer cars in the first quarter. Musk is cutting headcount by at least 10% and looking to accelerate new models, including less expensive vehicles that could be ready by 2025, if not before year end. Tesla right now, 187. Wow. Dude, that's incredible. Imagine it breaks 200 today. Yeah, imagine it breaks 200 today. Imagine. Could you imagine? Now, here's the thing again, and we were talking about this last week. If retail bought the dip and they got it right before everyone else got it right in the context of the street, right? That's just going to be incredible to see. So again, imagine retail buying the dip from 138 to 180 once again beats Wall Street. Almost every firm besides Bank of America downgraded them after their earnings last week. The numbers were not good, so you could understand the downgrade, but Elon laid out a vision and increased the timeline on that vision from expectations. We forget about that. He said 6 months earlier, instead of H2 2025, H1 2025, the new, not only robotaxi, but new fleet of vehicles, which are built on their new next generation platform, will start to become real and in production, potentially even rolled out. So they increased the timeline, which is the only good thing out of that earnings, but it was probably the most monumental part of that earnings. And that's why we saw some momentum in the stock. If this price action holds, then 140 will have been the bottom, which Ron Barron also said last week that now was the bottom. He said that at about 160. And it looks like so far he's right, because FSD is seeming to ramp up the momentum that it's been looking for a long time. Remember, Elon Musk said 2 quarters ago, the difference between Tesla being worth 0 and being worth trillions is FSD. 3 letters determine everything. And that is seemingly how the street is reacting right now in the context of Tesla. Jaz says Tesla's crazy. I feel bad not adding up at 138, 140. Yeah, I think a lot of people are now going to start feeling the regrets of 138, 140. If this holds, right? Like, let's see. But dude, it's up 11%. It might touch 190 today. It might touch 190 today, which would be incredible. Absolutely incredible in the context of Tesla. Young CEO says, I bought 5,000 more Tesla on Friday. I love it. 1 week later, my Tesla calls. Correct. If I had done 2 weeks out for the 185 versus 1 week out, I would have been in the money on those. Not bad at all, though, man. It's really exciting. This is the momentum that people have been looking for with Tesla. And also, Cathie Wood, we got to give her credit. She's been buying every dip, like, aggressively, dude. Like, she has not held back. I mean, you at least got to give them a little bit of credit in terms of how she's conceptualizing the Tesla story. Does it get to 2,000 in 5 years? I don't know. Elon did quote tweet her yesterday and says he agrees with her. He didn't literally say he agrees with her price target, but he basically said he agrees with her price target. And so Elon's pretty bullish because he thinks FSD and robotaxis is going to do what it needs to do. Here's Kathy talking about Tesla and robotaxis writ large last week.
Are going to evolve. Very importantly, research on how these technologies are going to evolve is critical. You'll see many strategies will put anything that has the word artificial intelligence into a portfolio, anything in the prospectus, let's say. That's one way of doing it. But we are much more focused on who's going to take the lion's share of this market. And it's a winner take most market in many cases. The most interesting one to us, and probably the one that will scale enormously during the next 5 to 10 years, is robotaxis or autonomous taxi platforms. That's the convergence among robotics. Autonomous vehicles are robots. Energy storage, they will be electric because costs are coming down with this new technology, and artificial intelligence. They'll be powered by AI. We believe that that entire opportunity is going to generate revenues of $8 to $10 trillion in 2030, half of which will go to the platforms like Tesla. Tesla is the biggest artificial intelligence project in the world, we believe, as it moves towards this goal of autonomous taxi networks.
I mean, look, 8 to 10 trillion by 2030 is a lot. I don't think that's going to happen because I think the regulatory approvals will make it take more time, but there will be a robotaxi network by 2030. I think all of us can just, and we're not saying that because we're hoping on Elon to execute. We're seeing the progress of FSD. It's becoming real. I've been starting to watch a lot more FSD 12.3 videos on YouTube, just like seeing for myself, because I don't have a Tesla, like what it actually looks like. And, you know, Elon said on the call, if you haven't tried it, you can't invest in the company because you don't really know what you're investing in. And it's fair. As a consumer product, Tesla can scale to billions of people. That's the benefit of being a consumer company. And when you have software, it's almost like infinite scale, right? And there's beautiful margins on that. So the question then becomes, do you believe that that product, that software can actually scale? And if FSD is going to have its ChatGPT iPhone moment, which I don't think it's had yet because it's not like unsupervised, right? Not perfect. Maybe that happens in the next 2 to 3 years. The stock probably is going to front run that a bit before they decide to go down. The other thing that's important, we got the SOFI call in 3 minutes, is that going into Tesla earnings, everyone thought, or including myself, that the M2 would be scrapped, right? And that Elon was transitioning. That's not the case. That's just not happening. Like that was false. In fact, they're accelerating the production of the M2. So that is in and of itself, if that's a reason that caused the like at least 20% decline, and maybe Tesla deserves to be down 20% because of the numbers, but then the extra 20% was because of that reason, maybe that's not a good reason, right? And that's why we're seeing Tesla go higher right now. And so that's what we got. SoFi Tech Platform grew 21% year over year. Contributions grew from 19% to 33%. Yes, that is good. I think now on this call, we've got 2 minutes until the call starts. The real question is going to be, can Anthony Noto say something that gets the street scared that they don't own enough SoFi? I think that's the question. A Crime Story Cafe says, problem is Amit hasn't taken the time to understand the SoFi earnings. He's been moaning about the results, but they are strong results. I agree. They are strong results. And I understand the SoFi bulls, including myself, are upset that the stock is not moving up right now. But as an analyst, you have to, in real time, try to figure out why the stock isn't mooning. And in my real time analysis, even though the results are phenomenal, the growth is only 15% year over year. Remember, we did this on Saturday for whoever joined my Saturday night stream. We looked at the price to book for every bank in the world. I mean, we did like 20 banks. It's 1 to 1.4. SoFi is at 1.5. So it's valued the same as a JP Morgan. You know, Palantir's price to book is 13. NVIDIA's price to book is 40. So the tech companies get a way bigger price to book. The banks don't, because it's the value of your loans at the end of the day. There's not that much of a crazy multiple to try to put on how to value a bank. The tech side of the business is what gives SoFi the momentum. And that tech side of the business is growing really nicely. The question is, how much does the street care about that tech side of the business growing enough to contribute to overall growth? And overall growth is still 15%, even though the tech side of the business is 21%. That is my real-time analysis for why I think the stock is not moving up. That's my perspective. Crime Story Cafe says, admit the other banks do not have the tech platform. That is correct. They don't. And that's the reason I'm invested in SoFi. The question is that enough of a reason to get it to go higher? All right, let's see what Noto has to say. The call should be starting in about 20 seconds. And we'll see what goes on here. The other thing I also didn't like about SoFi is the deposits. I felt like that should have been a little higher. But in general, it was still, enough to... The stock should be $10 right now. Like, in my opinion, on a fair value basis. But because it's been depressed and the short float is high, Noto's got to get the street to get excited. And this call will give us a perspective on if that happens. Have you looked at Rubrik? No, I haven't. I know they're filing to go public, though. I haven't looked at them yet. I know Microsoft, I think, is the early investor, so we'll look at those as well. Amit, did you get your Dunkin'? Yes. And I haven't drank it yet because I've been talking, so it's getting watery now. So I've got to drink up the water caramel latte while Noto's talking. Here we go.
Good morning. My name is Jordan, and I will be your conference operator today. At this time, I'd like to welcome everyone to the SoFi Technologies Q1 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there'll be a question and answer session. If you'd like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you'd like to withdraw your question, please press star followed by 2. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's first quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Christopher Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. Q1 was another exceptionally strong quarter for SoFi. We continue to successfully execute on our strategy of making SoFi the one-stop shop for digital financial services. We expected that 2024 would be an important year of transition. Heading into this year, we had a conservative outlook given interest rate volatility, industry liquidity, inflation, and macroeconomic environment concerns. We planned for continued strong growth from our financial services and technology platform segments, up 50% year over year, offsetting our plan for lending to be 92 to 95% of 2023 revenue. And we set out to strengthen our balance sheet and capital ratios by continuing to grow our tangible book value. I'm proud to report that our team delivered across each of these fronts and more in the first quarter of 2024. First, we responsibly grew revenue while further diversifying our business. We grew adjusted net revenue in Q1 to $581 million, up 26% year over year. This marks the 12th consecutive quarter of greater than 25% growth. We grew adjusted EBITDA to $144 million, up 91% year over year. This represents a 25% margin compared to 16% a year ago. I'm pleased to report that our financial services and technology platform segments make up a growing portion of our revenue quarter over quarter, contributing 42% of adjusted net revenue in Q1. This is up from 40% last quarter and 33% a year ago, and we remain on track to finish 2024 with our revenue mix near 50-50. Second, we posted GAAP net income of $88 million. This includes a $59 million one-time benefit from the recent exchange of convertible notes, which Chris will talk about more in a moment. After achieving our first quarter of GAAP profitability in Q4 2023, we committed to sustaining profitability for the full year of 2024, and we did so in Q1. we posted GAAP EPS of 2 cents per share, which excludes the benefit from the convertible note exchange. Third, we further reinforced our balance sheet for long-term growth. We grew tangible book value for the 7th consecutive quarter to $4.1 billion, an increase of $608 million from the prior quarter. Equally as important, our tangible book value per share now stands at $3.92, up 16% sequentially. We grew consumer deposits by a record of $3 billion and saw continued strong buying demands for our loans, selling over $1.9 billion of loans in Q1. SoFi Bank reported net income of $100 million with a 21% margin and a return on tangible equity of 11.7%. Our total capital ratio for SoFi Technologies is now 17.3%, a 200 basis point improvement from last quarter and well above our 10.5% regulatory minimum. Finally, our broad product offering, enabling people to borrow, save, spend, invest, and protect their money, continues to attract more and more members to SoFi. In Q1, we grew our member base to 8.1 million, up 44% from the prior year, adding 622,000 new members in the quarter. Just as important, we continue to see members adopt more products and deepen their relationship with SoFi. We recorded 989,000 new product additions in the quarter, with 93% of those product adds coming in our financial services segment. A remarkable milestone considering it's been only 5 years since we launched our first non-lending products and 2 years since we launched SoFi Bank. This increasingly diverse product relationship with our members is what maximizes the power of the financial services productivity loop and allows us to leverage our unique structural economic advantage. Despite external unpredictability in the year ahead, I remain as confident as ever in SoFi's future, our plans to sustain responsible growth, and our ability to deliver meaningful value to our shareholders. Before handing it over to Chris to cover our financial highlights and share updated guidance, I wanted to give a quick peek under the hood on our segment level results. Starting with financial services. We continue to drive acquisition and monetization and importantly, rapidly expanding margins. We achieved record net revenue of $151 million in Q1, up 86% year over year and 8% from the prior quarter. Demonstrating the strong operating leverage in this segment, we generated this 86% growth with only an 8% increase in directly attributable expenses year over year. The overall financial services segment achieved $37 million in contribution profit at a 25% margin compared to a $24 million loss in the year ago quarter. That margin is up 7 points from last quarter and a full 22 points from our first quarter of segment profitability achieved in the third quarter of 2023. This progress is notable given our significant investment across our money, credit card, and invest products. SoFi Money delivered strong growth, high-quality deposits and engagement, and higher average account balances, even as spending increased. We grew to 3.9 million SoFi Money accounts, up 61% year over year, with over 90% of our consumer deposits coming from direct deposit members. Our direct deposit members have a median FICO of 744, and over 50% of our newly funded SoFi Money accounts set up direct deposit by day 30, presenting ample opportunities for cross-buy into other SoFi products. As these members make SoFi Money their account of choice, spending follows with overall debit transaction volume exceeding $1.9 billion in the quarter, up 20% from the prior quarter and over 150% year over year. Looking at our credit card and invest products, we previously shared that these are our heaviest areas of investment in the financial services segment, with current losses of nearly $100 million annually on a run rate basis. However, through improved unit economics and scale, we expect that these products will eventually contribute profit similar to our progress with SoFi Money. Next, turning to our technology platform segment. Our consistent product development and successful shift in sales strategy has enabled us to diversify growth and pursue larger, more durable revenue opportunities. In Q1, we exceeded $94 million in revenue, representing 21% year-over-year growth versus 13% last quarter, in line with our guidance for accelerating growth. Our tech platform segment contribution margin was 33% compared to 32% last quarter and 19% a year ago. Demand from traditional financial institutions and clients in non-financial categories remains strong. While lead times for winning RFPs and integrations and time to revenue are measured in multiple quarters and years, not months, we're seeing the transition to modern processing and modern cores playing out as envisioned. We also made significant strides in product development in Q1. We enhanced our partnership with the Bancorp to offer real-time payments, improving the money movement hub, enabling multiple new use cases for B2C and B2B clients. We launched post-purchase buy now, pay later for banks and fintechs to deliver flexible financing solutions for debit and credit purchases. Galileo and SoFi Bank partnered to launch a small business financing card program with Rapid Finance. And importantly, we continue to make progress with our growing pipeline of new partners in the quarter. And finally, turning to lending. As we shared last quarter, we've taken a more conservative approach toward originations, given our concerns around rate uncertainty and the broader macro climate. For Q1, adjusted net revenue of $325 million was flat year over year. Personal loan origination growth slowed to 11% year over year to $3.3 billion, in line with our more conservative approach. In fact, the balance of personal loans on our balance sheet declined 2% quarter over quarter. Student loan originations grew 43% year over year to $752 million, and home loan originations increased 274% year over year to $336 million. A record 82% of the segment's adjusted net revenue was derived from net interest income, compared to 76% last quarter and 62% in the year-ago quarter. This is a direct benefit of our bank charter and our ability to hold loans longer when advantageous. The percent of adjusted lending revenue from net interest income has more than doubled since we launched the bank 2 years ago. Together, these efforts contributed to great results for SoFi in the first quarter of 2024. I am incredibly proud of our team's perseverance to serve our members and clients' financial needs in face of continued volatility and uncertainty around the world, while delivering good, consistent growth, profitability, and shareholder value creation. With that, I'll hand it over to Chris.
Thanks, Anthony. The first quarter demonstrates strong evidence of how our increasingly diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the first quarter of 2024 versus first quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. For the quarter, we delivered adjusted net revenue of $581 million, with growth of 26% year over year. Adjusted EBITDA was $144 million at a 25% margin. This represented over 8 points of year-over-year margin improvement, demonstrating significant operating leverage across all functional expense lines. In fact, sales and marketing declined as a percentage of adjusted net revenue by 9 points relative to the year-ago quarter, while total non-interest operating expenses declined 16 points year over year. We delivered our second quarter of GAAP profitability, with GAAP net income reaching $88 million, a $122 million improvement year over year. Net income included the benefit of a $59 million net gain associated with the exchange of a portion of our 2026 convertible notes at a discount for equity during the quarter. We reported GAAP diluted EPS of 2 cents, which was not impacted by the gain from the convertible note exchange. Now on to the segment level performance.
We're tanking, folks.
Starting with financial services, where net revenue of $151 million increased 86% year over year, with new all-time high revenue for SoFi Money and lending as a service, as well as continued contributions from SoFi Invest and credit card. Overall monetization continues to improve, with annualized revenue per product of $59, up 31% year over year, versus $45 in Q1 2023. This is driven by higher deposits and member spending levels in SoFi Money, greater AUM and monetizable features in SoFi Invest.
Yo, what the fuck is going on?
Robust growth within SoFi credit card spend. Net interest income increased 106% year over year, primarily driven by $11.5 billion growth in deposits year over year. Our non-interest income increased 34% year over year, primarily driven by two factors: interchange, which grew 65% year over year, based on over $7.5 billion in annualized spend, and referrals from our lending as a service product, which grew 32% versus the prior year period. Contribution profit reached $37 million at a 25% margin for the quarter, even as we continue to invest to rapidly grow this segment. Despite our invest and credit card businesses collectively losing nearly $100 million on an annualized basis, we still achieved strong margins. Lastly, we reached 10.1 million financial services products in the quarter, which is up 42% year over year, with 919,000 new products in the quarter. We reached nearly 3.9 million products in SoFi Money, 2.2 million in SoFi Invest, and 3.6 million in Relay. Shifting to our tech platform, where we delivered net revenue of $94 million in the quarter, up 21% year over year and down 3% sequentially. Annual revenue growth was driven by strong performance from new clients onboarded over the last 9 months, large bank deals signed in Latin America, and strong monetization of existing clients launching new products on our platform. Galileo accounts grew 20% year over year to 151 million. The segment delivered a contribution profit of $31 million, representing a 33% margin. We continue to leverage investments made in the segment as we continue to position tech platform for higher rates of diversified, durable growth going forward. We expect tech platform revenue to accelerate in 2024 with strong margins. Turning to lending, first quarter adjusted net revenue remained flat year over year at $325 million, with $208 million of contribution profit at a 64% margin versus $210 million a year ago. These results were driven by a 33% year-over-year growth in our net interest income, while non-interest income was down by 53%. Growth in net interest income was driven by a 59% year-over-year increase in average interest earning assets and a 114 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 5.91% for the quarter, up 43 basis points year over year. I'd also highlight our $3 billion of deposit growth in the quarter compared to the $242 million of net loan growth on the balance sheet. This has allowed us to continue to reduce our reliance on outside warehouse funding, which is 226 basis points more expensive than our deposits. As a result, we reduced our warehouse utilization this quarter by $2.4 billion. The 226 basis points of cost savings between our deposits and our warehouse facilities continues to support our net interest margin and translates to nearly $500 million of annualized interest expense savings at our current deposit base. It also underscores the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. We expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. On the non-interest income side, Q1 originations grew 22% year over year to $4.4 billion and were driven by growth across our personal, student, and home loan products. Personal loan originations growth slowed to 11% year over year and 2% sequentially to $3.3 billion, which was anticipated and in line with our more conservative approach given macro uncertainty. Our student loans business saw origination volume grow 43% year over year, with a slight 5% decline sequentially to $752 million. Home loans grew by over 270% year over year and 9% sequentially to $336 million. Our personal loan borrowers' weighted average income is $169,000, with a weighted average FICO score of 746. Our student loan borrowers' weighted average income is $146,000, with a weighted average FICO of 768. In the first quarter, we sold portions of our personal loan, student loan, and home loan portfolios, totaling over $1.9 billion. That comprises approximately $1.26 billion in personal loan principal, $300 million in student loan principal, and nearly $350 million in home loan principal. In terms of personal loan sales, we closed $500 million of loans in whole loan form and $700 million in ABS at a blended execution of 105.7%. These had similar structures to other recent personal loan sales, with cash proceeds at par or at a small premium to par, and the majority of the premium consisted of contractual servicing fees that are capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. As a result of the personal loan sales in the quarter, the quantity of personal loans on our balance sheet declined sequentially despite growth in originations. Additionally, we sold $62.5 million of late-stage delinquent personal loans principal in the quarter. Typically, we do not sell delinquent loans until they are charged off, but we were able to generate positive value generated from both recovery and servicing value relative to letting the loans charge off and sell after the fact. As discussed during Q4 results, roughly 15% of our losses came from credit tiers that we ceased originating several quarters earlier, which represented 3% of unpaid principal balance. We were therefore able to reduce exposure to those credit tiers as the loans run off and become a much smaller portion of overall unpaid principal balance. In addition, we continue to make adjustments to our credit underwriting model in line with the internal and external indicators underlying our risk scorecard. Moving to our student loan sales, we closed $294 million of loans in whole loan form at an execution of 104.9%. This sale had no accompanying loss share provision nor senior secured financing option. Finally, our $344 million of home loan sales were sold at a blended execution of 100.9%. Also in the quarter, we executed $399 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed term structure and are secured against the underlying assets, therefore equivalent to the investment grade bonds if we were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Turning to credit performance, our on-balance sheet 90-day student loan delinquency rate was 13 basis points, while our annualized student loan charge-off rate was 60 basis points. Our Q1 on-balance sheet 90-day personal loan delinquency rate was 72 basis points. Our annualized personal loan charge-off rate decreased to 3.45% from 4.02% in Q4, including the impact of asset sales, new originations, and the delinquency sale in the quarter. We anticipate ongoing normalization in credit performance toward pre-pandemic levels of 7 to 8% life of loan losses. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.2% as of quarter end, down from 104.9% at the end of Q4, and well below the 105.7% blended execution achieved on the $1.2 billion in personal loan sales. The lower personal loan mark was primarily a function of the discount rate increasing by approximately 30 basis points to 5.8%. This was driven by the underlying benchmark rate increasing by approximately 50 basis points and spreads tightening by 20 basis points in line with industry trends. Importantly, the benchmark rate change and the spread change are empirical as they are actual market observed inputs, not assumptions. In addition, the mark was negatively impacted by the annual default rate increasing by 9 basis points to 4.85% and the annual prepayment speeds increasing by 150 basis points to 24.7%, which has an immaterial impact on the overall change in the mark. When a borrower prepays, we are still capturing the principal, and the impact to the value of the asset is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. The weighted average coupon of the personal loan portfolio remained unchanged at 13.8%. For our student loan portfolio, the fair value mark remained unchanged at 103.8% at quarter end. In terms of the inputs, our weighted average coupon remained flat at 5.6%, annual losses remained flat at 60 basis points, prepayments increased by 8 basis points to 10.5%, and the discount rate remained unchanged at 4.3%. As mentioned previously, we sold $294 million of student loan collateral in the quarter. Had we not sold those assets, the student loan discount rate would have increased by a similar magnitude as our personal loans business. Switching to our balance sheet, where we remain very well capitalized with ample cash and liquidity. Assets grew by $1.2 billion, largely as a result of $242 million growth in loans and approximately $803 million growth in cash equivalents, and investment securities. On the liability side, deposits grew by $3 billion sequentially to nearly $22 billion. As mentioned earlier, we reduced our reliance on warehouse facilities through our robust deposit growth and exited the quarter with approximately $800 million of warehouse debt drawn. In Q1, we opportunistically executed 2 transactions in order to optimize our financing structure and bolster our capital capacity. First, we issued $862.5 million in convertible notes due in 2029 at a 1.25% coupon. The net proceeds are being used to replace higher cost financing, including the redemption of the $320 million of outstanding Series 1 preferred stock that carries an annual dividend of 12.5%, which was set to increase to over 15% in late May. In total, this new convertible issuance should reduce our financing expense by $40 to $60 million per year, including cost-saving opportunities with the remaining proceeds. Second, we agreed to an exchange of $600 million principal of our convertible notes due in 2026 for shares of SOFI common stock. This was a notable discount compared to what we would have had to pay in 2 years. This transaction generated a gain of $59 million for us in the quarter, while notably reducing our 2026 maturities and bolstering our funding capacity. When viewed in total, these transactions are accretive to book value and net income and have minimal impact on a fully diluted EPS basis. In terms of our regulatory capital ratios, our total capital ratio of 17.3% improved by 200 basis points from 15.3% last quarter, due in large part to these transactions, and remains comfortably above the regulatory minimum of 10.5%. While we don't intend to utilize the excess capital capacity in the year, given our view of the macro uncertainty, these transactions put us in an even stronger position for years to come. Lastly, we grew book value to $6.1 billion and tangible book value to $4.1 billion. We recorded tangible book value per share at $3.92, up 16% quarter over quarter. Now moving on to our updated guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, our continued keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist going forward, even in light of the existing macro backdrop. 2024 remains a transitional year for SoFi, as the tech platform and financial services segments together will drive our growth and increase from 38% of total adjusted net revenue in 2023 to approximately 50% for all of 2024. For the full year 2024, we now expect to deliver adjusted net revenue of $2.39 to $2.43 billion, which is $25 million higher than our implied prior guidance range of $2.365 to $2.405 billion. This guidance assumes lending revenue will be 92 to 95% of 2023 levels, which is unchanged from prior guidance, and tech platform will grow approximately 20% year over year, which is also unchanged. We expect the financial services segment revenue to grow more than 75% year over year. We now expect adjusted EBITDA of $590 to $600 million, above our prior guidance of $580 to $590 million. And that incorporates increased investment into more product innovation, new businesses, services, and member benefits. This represents 15 to 17% adjusted net revenue growth and a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $165 to $175 million, above prior guidance of $95 to $105 million, which includes a $59 million gain associated with the convertible note exchange. We expect fully diluted GAAP EPS of 8 cents to 9 cents per share, above prior guidance of 7 cents to 8 cents per share. We now expect growth in tangible book value of approximately $800 million to $1 billion for the year versus our previous guidance of $300 to $500 million, given the benefits of the recent convertible debt exchange, along with the effects of new convertible issuance. We now expect to end the year with a total capital ratio north of 16% due to those transactions versus our previous guidance of 14%. We continue to expect to add at least 2.3 million new members in 2024, which represents 30% growth. For Q2, we expect to deliver adjusted net revenue of $555 to $565 million, adjusted EBITDA of $115 million to $125 million, and net income of $5 to $10 million. In terms of phasing, you can see for the past 2 years that the second quarter is seasonally flattish for lending, which, coupled with our more conservative approach toward originations this year, should drive a sequential decline in lending revenue, which largely offsets tailwinds in the 2 other segments. In terms of operating expenses, you can expect low single-digit sequential growth as we continue to invest in future growth. Overall, we couldn't be more proud of our Q1 results and continued progress. Having delivered over $581 million of adjusted net revenue and $144 million of adjusted EBITDA, we continue to make great progress against our long-term objectives in the quarter and remain very well capitalized to achieve our vision of making SoFi the one-stop shop for digital financial services. With that, let's begin the Q&A.
All right. This is what matters.
At this time, I'd like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone.
This is what we're
keypad.
looking for.
Please keep in mind, we'll take only 1 question per person at a time. Please rejoin the queue for any additional questions.
Here we go.
Your first question comes from the line of John Hecht of Jefferies. John, please go ahead.
Morning, guys. Excuse me. Morning. Thanks for taking my question. Chris, you gave some of the metrics in the personal lending book on, charge-offs and so forth. I'm wondering what you're looking at this point in terms of payment trends and kind of the underwriting factors that informs your credit outlook, and maybe if you could give us your thoughts on that as well.
Sure. I'll start, and Anthony can chime in. So we feel really good about our credit and the underlying performance of our loans, and everything is performing in line with expectations while we continue to see the underlying signs of improvement. In Q1, our net charge-off rate was 3.45%, which was down from 4.0% in Q4, which included the impact of asset sales, new originations, as well as the delinquency sale that we did in the quarter. In terms of our outlook, we anticipate ongoing normalization in credit performance towards pre-pandemic levels of 7 to 8% life of loan losses, which is in line with what we said last quarter. Historically, life of loan losses could reasonably be approximated by the weighted average life of the portfolio multiplied by a given quarter's annualized net charge-offs. However, while our life of loan loss trends and our outlook are unchanged, the relationship to any given quarter's NCOs has changed. In fact, what we're now seeing, particularly with how recent vintages are playing out, is a more rapid factoring down of loan principal as a result of increasing prepayment speeds and demand for shorter-term loans. What that means is that we're starting to see a greater proportion of losses happening sooner, and as a result, we're seeing an outsized impact on NCO rates that are not directly correlated to the life of loan losses when applying the normal 1.5x weighted average life to them. In other words, for any specific recent vintage, you can expect to see losses lower in the latter stages than before and higher in the earlier stages. However, our life of loan losses will remain in line with our 7 to 8% outlook. What gives us confidence in that 7 to 8% outlook is that we have a decade of experience of underwriting high-quality credit. And as we've been talking about for quite some time, optimizing the credit profile of those we underwrite to is part of our DNA. We underwrite to cash flow. We have very robust analytics, detailed vintage-based models, and forecasts, which are managed by our second line of defense. And all of our outlooks are data-driven, resulting in the strong performance and outcomes that we've been able to achieve. Now, when looking at some of the specific numbers and trends that we're observing today, we've seen a material improvement in performance since we started tightening credit in mid-2022. When looking at recent vintages and their loss rates at comparable points in time to our Q3 2022 vintage, we've observed the following. In Q1, our Q1 2023 cumulative vintage losses through 12 months of being on the books was approximately 20% better than the Q3 2022 vintage over that same period of time, 12 months of being on the books. If you look at our Q2 2023 cumulative vintage losses through 9 months of being on the books, that was also 20% better than the Q3 2022 vintage over the same period of time. And then finally, our Q3 2023 cumulative vintage losses through 6 months of being on the books was nearly 40% better than the Q3 2022 vintage over the same period of time. So putting it all together, the performance improvement that we've observed in recent vintages, coupled with the short duration nature of the assets and the remaining principal on older and newer vintages prior to making credit cuts, gives us a very high degree of confidence in our 7 to 8% life loan loss outlook.
Our next question comes from Mark DeVries of Deutsche Bank. Your line is open.
Yeah, thanks for taking my question. Was curious whether, just kind of given where you are now with the equity capital levels, whether you feel you have enough sources to support future growth, or do you potentially see yourself having to raise additional outside equity?
Thanks for the question. We had significant excess capital prior to the transactions that occurred in the quarter. Our risk-based capital level was, over 15%. It's now over 17%, well above our regulatory requirement. And given our outlook on lending, there's no reason for us to change our stance on that business. We went into 2024 with a view that our growth would be driven by the combined impact of tech platform and financial services business. Those businesses are now big enough in terms of total scale and profitable enough that we could put our resources behind them, still grow as we did this quarter, over 26% year over year, while the lending business was essentially flat year over year. So our decision to make that transition in 2024 wasn't driven by capital. We had excess capital and could grow it much faster. We have even more excess capital now, but our stance hasn't changed because that wasn't the reason for keeping it relatively conservative. We feel great about the trends in tech platform and financial services. I think it's quite remarkable, the growth rate that we're achieving there and the level of profitability. If you had asked me 6 years ago, could we deliver in the first quarter of 2024, 25% revenue growth, 25% EBITDA margin, growth in tangible book, about 16% sequentially, in addition to record deposits and strong member growth of 44%, with lending being flat, I would have said not a chance. So it's a real testament to diversification of our business and the optionality we have to drive growth in different environments. But we started in October talking about higher for longer. And while the market and different government officials led people to believe there'd be 6 rate cuts at one point, now we're down to 1 to 2 rate cuts. We think we took the appropriate stance and we're well positioned to play where the economy goes in 2024.
Our next question comes from Dan Dolev of Mizuho. Please go ahead.
Hey guys, really strong results. Congrats. I have a question about the NIM, really stable NIM trends. Can you, Chris, comment on the future NIM trends, how you're seeing them? I would appreciate it. Thank you.
Sure. Thanks, Ed. So yeah, we've been very successful in maintaining healthy net interest margins and continuing to expand them over time. In Q1, our net interest margin was 5.9%, which was up 43 basis points year over year. And more importantly, what we've seen is year-over-year net interest margin expansion in every single quarter throughout 2022 and 2023. Our ability to constantly expand NIM was a function of maintaining loan pricing betas that are above 100% in a rising rate environment, scaling our high-quality deposits, and maintaining betas below 100% in a rising rate environment for our loans business, as well as capital structure optimization moves that provide us with a lower cost of funding. We do expect to maintain healthy margins for the foreseeable future, breaking it down between the asset side and the liability side. On the asset side of the equation, in a higher for longer rate environment, we do expect to maintain strong yields north of 9%, which is consistent with what we've observed over the course of the last several quarters, even in light of seeing a mix shift away from personal loans on the balance sheet. And then on the liability side, we expect to be able to maintain a healthy cost of funding, even while maintaining a highly competitive APY on our SoFi Money product. That's a function of a few things. First, we recently issued the $862.5 million of convertible notes at a rate of 1.25%, which was used to displace much higher cost of funding. Second, we still have room to fund more of our balance sheet with lower cost deposits. We have $2.6 billion of higher cost brokered CDs, $800 million of warehouse lines that are outstanding, and about $500 million of a corporate revolver outstanding. So net, we're really confident in being able to maintain net interest margins above 5% for the foreseeable future.
Our next question comes from Kyle Peterson of Needham & Company. Your line is open.
Great. Thanks, guys. Good morning, and appreciate you taking the question. Just wanted to dive a bit more into deposit growth and pricing. Obviously, been really strong growth on that front. But if you could give a little more detail, specifically on deposit betas and what the biggest drivers of growth will be, particularly if we are in a higher for longer environment, that would be great.
Yeah, Chris can comment on the betas. What I'd say is we raised our 24 revenue outlook in terms of the range by more than we beat in Q1. And that's because of the positive tailwinds we're seeing in both tech platform as well as financial services. We had record growth in deposits in Q1 of $3 billion. We've seen really strong debit spending trends. We're annualizing more than $8 billion now. So that will definitely continue to have a tailwind. We're uniquely positioned to be able to provide an attractive APY in the deposit business, given the fact that we're an originator and we can match up what we're lending at versus what we're paying out from a depository standpoint. In addition to that, we've really seen strong trends from the underlying existing customers for the tech platform business, in addition to uptake of new products such as payment risk platform, as well as the connected chatbot product. So we feel good about the largest components of our revenue going to the back half of the year. And then we have the additional contributions from businesses like SoFi Invest, as well as our credit card business, and efforts that we had with Lantern on small, medium business lead generation. Those are all contributing smaller dollar amounts, but moving quite strongly in a direction of continued tailwind as well.
And then from a beta perspective, we ended up exiting the quarter with $21.6 billion of deposits. That was up $3 billion quarter over quarter, with more than 90% of the deposits coming from direct deposit members. We ended up launching a checking and savings product back in February of 2022 with an APY of 1%. And then at the end of Q1, our APY was 4.6%. So our overall beta over the course of time has been in the 65 to 70% range.
Our next question comes from Reggie Smith of JP Morgan. Please go ahead.
Hey, good morning. Thanks for taking the question. I wanted to kind of dig into the financial services segment a little bit. One of the disclosures you guys gave in the press release is the FICO score of some of your new depositors. I guess my question is, what's your appetite for, really growing the credit card business, and maybe talk about like what that looks like ultimately growing that. And then my second question, still related to financial services, is at what point would, I guess, interest from credit card outweigh maybe some of the transfer pricing that you're getting from the lending segment? Is that an ultimate goal where that business is driven more by the actual lending of the credit card business? If that makes sense. Thanks a lot.
We're really excited about where we are with credit card. We've had a great journey in launching the credit card, learning quite a bit about our go-to-market strategy, how we're marketing and targeting potential new members with credit card, in addition to understanding the underlying credit trends and what the right credit model is, in addition to other factors like fraud and risk overall. We've brought in significant subject matter expertise in the credit card business that have actually built near prime cards in the past. product remains a prime product. It will continue to be a prime product. But we felt like, coming out of 2023, that we had the learnings that allow us to be more aggressive in 2024 in that business as things unfold. So expect us to invest more in the business and see some good innovation in the back half of the year based on the learnings that we've had from the last 3 years. It's a great product. It has a high ROE product, but there is a J curve that you have to go through. I think one of the things that may often be missed by the broader investment community is that now we have 8.1 million members. We can market our credit card to known members with known credit profiles, known spending capabilities, cash flow capacity, et cetera. And so we're at that point now where we would really like to put more resources behind a strategy that we think is really working in our benefit as it relates to the interest rate and in relationship to the rest of our funding costs. I'll let Chris answer that.
Yeah, so right now, this is a super high ROE business, and in terms of the mix shift towards the lending product, we still have significant low cost of funding through our deposit base, and as Anthony mentioned, we're going to start scaling this business more rapidly. We have started to see some good green shoots in terms of early stage delinquencies and losses that are performing materially better than historical vintages, so we can start investing more heavily in this business.
Our next question comes from Peter Christiansen of Citigroup. Your line is open.
Good morning. Thanks for the question. Great to be on the call. I'm curious about network fees in the financial services segment, which were down quarter over quarter. I think the expectation there was that they would rise sequentially. Just if you can give a little bit of color there. Thank you so much.
Yeah, absolutely. So we are seeing really good spend behavior. We had about $1.9 billion of overall spend in the quarter. That was up from $1.5 billion in Q4 and $1.2 billion in Q3 of last year. We did benefit from a small one-time benefit from a partner on the network fee side. But what you can expect going forward is relatively linear growth with spend behavior over the course of 2024. So there was a one-timer in Q4 that made for a tough comp, but going forward, you can think of linear growth for relative to spend.
Our next question comes from Jeff Adelson of Morgan Stanley. The line is yours.
Hey, good morning, guys. Thank you for taking my question. Chris, maybe just to circle back on the improvement in the charge-off rate for personal loans. Seems like we saw a 15% sequential decline there, sort of in line with the comments you've made about the 15% of credits coming out of the system over the last quarter and this quarter. How long should we maybe expect that to persist? I know you're still talking about the charge-off rates normalizing towards your life of loan targets. Just kind of curious how that short-term dynamic might play out. And then I guess, the comments on keeping your excess capital this year in light of the macro uncertainty. Are you hearing anything from your regulators on there about, any sort of buffer you might need to keep? Have you tried to run an excess capital drawdown scenario from an internal stress test, or have you ever tried to size that? Just kind of curious because it seems like the macro uncertainty is a bit at odds with what we're hearing from other lenders, which are pointing to a little bit more of a stable to improving macro. So just trying to understand why maybe you wouldn't lean in a little bit more on the personal loan side here.
Yeah, sure. I'll take some of the losses. Anthony can hit on some of the excess capital. On the losses front, we did see a decline in net charge-offs, but what's important is the net charge-off rate is a function of a number of factors. It's originations in the period, it's pay downs, it's a term of the loans that we're underwriting to. We did benefit in this period from the late stage delinquency sale that we did, which helped drive the overall losses down sequentially. What I would guide you to is that 7 to 8% life of loan loss outlook, which we feel extremely confident in given some of the loss trends and delinquency trends that we're seeing in our more recent 2023 vintages. On the excess capital point.
Yeah. So what I'd say is we 100% have the option to drive the lending business faster if we'd like. We do stress tests, as you would imagine, internally and externally for others across the entire ecosystem in which we operate. And starting the year at the risk-based capital that we had at 15%, even with stress tests, gave us ample opportunity to invest in that business at a rate that we wanted to. I would say our outlook for the lending business is more reflective of the uncertainty as opposed to whether or not there are great trends. As you see in our lending business, it's actually performing quite well. We're driving great returns there, good steady credit performance as expected. It's not that we're expecting a huge drop off the cliff or huge deterioration. It's that we've gone from, in the last 6 months, the market anticipating 6 rate cuts as you got into the sort of October time period to then, now you're down to 1 to 2 rate cuts. And prior to the 6 rate cuts, people were talking about higher for longer in October. And so there's been a complete swing of the interest rate environment. As you just saw in the banking industry, that creates liquidity issues for different banks. We're concerned about others not being able to manage the liquidity issues. Last year at this time, we were experiencing First Republic going under. That was not anticipated. I don't know what's around the next quarter. I do know that we have a great member base. We have excess capital well above what we started the year with at 17%. So we have the option to grow the business much faster if we choose to. And one of the things we haven't talked about is we're now selling a significant amount of loans. We sold $1.9 billion of loans in the quarter. That demand remains strong. And so to the extent that that demand continues to increase and remain strong, and the environment remains sort of stable and more predictable, could we be more aggressive in the lending business? 100%. We have the capital, we have the go-to-market strategy, we have the flexibility in the balance sheet, and we have the aptitude to be able to do it. We're just taking a very conservative view to make sure we don't go into an environment that we're completely unprepared for. Taking a conservative stance gives us the most optionality to do more, but not necessarily have to do less.
Yeah, and the only other thing I would add to quantify some of those numbers in terms of our overall capacity is that we have more than $20 billion in capacity to originate loans. And even though even if we were to originate at that level, we would remain well above all regulatory minimums. In terms of what's driving the overall $20 billion, first, we expect to generate $800 to $1 billion of tangible book value in 2024, which translates to about $6.5 to $8 billion of incremental capacity. Second, loans are amortizing or paying down at an annual rate of $9.5 billion. Third, we have our previously announced $2 billion forward flow agreement, in addition to a number of on-the-run transactions that we're doing in the capital markets front. Demand is extremely strong. We did $1.9 billion of sales this past quarter. And then lastly, we have incremental headroom in our overall capital ratio. So having said that, we have sufficient capacity, but we are taking a conservative approach.
Our next question comes from Mihir Bhatia of Bank of America. Your line is open.
Hi, good morning, and thank you for taking my question. I wanted to switch to the tech segment for a second. You had 20% account growth this quarter. I was wondering if you could comment on a couple of things there. One is, can you just comment on what's driving that? Maybe talk about some of the key customers you maybe added in the quarter. Also, just curious if you could provide some examples of the larger clients you have won since transitioning the sales strategy to focus on these large clients. And then just relatedly on the segment, margins improved nicely. And I think you've talked about this being a margin expansion year, but can you just comment on the margin trajectory from here? Thank you.
Yeah, in terms of the tech platform, we saw good, consistent trends there. The tech platform grew 21%, which was an acceleration in year-over-year growth compared to Q4 and Q3. And Q4 also accelerated. We expect the trends there to continue. We have a really sizable client base with growing underlying users in that client base, in addition to driving additional product attachments to our existing clients. We're also seeing a greater contribution from new clients over the last 9 months. As it relates to the broader macro environment for technology platform segment, the demand and interest in using our technology platform, our modern Gen 3 core, as well as our API-based payment platform, issuing platform, is as high as it's ever been. And we continue to sign up new partners. I'd say those new partners fall into a couple of buckets. We are converting people from other competitive processing sites to Galileo. In addition to that, there's a lot of demand still from partners that haven't historically used an issuing platform or processing platform like Galileo that are transitioning to that platform from a sector standpoint. And then in the large financial institutions, the demand for monitoring cores and processing continues to be really robust. The timing on those deals is really driven by those end customers. We haven't lost any of the RFPs. We've continued to be down selected as big financial institutions go from a large RFP to a few select partners. So we feel good about our chances there. We're not expecting to win 100% of those deals, but we feel like we can win our fair share. Those deals will take longer to not only sign up, but to also implement. And so the contribution from that is, quarters, not months after they're announced. But we feel great about the current trends there, and that's why the acceleration happened in the quarter. Q2 is a seasonally weaker quarter for the technology platform business, but the year-over-year growth rate is what people should focus on because that eliminates the impact of seasonality, and that accelerated.
Our next question comes from Terry Ma of Barclays. Your line is open.
Hey, thanks. I just wanted to dig in a little bit more on the late-stage delinquency personal loan sales. Can you maybe just talk about the structure and execution around that and whether or not you plan on selling more?
Yeah, absolutely. So in Q1, we ended up selling $62.5 million of late-stage delinquent personal loans in the quarter. Typically, we do not sell delinquent loans until they're charged off. But we were able to generate an opportunity where we're able to generate positive value relative to letting the loans charge off and sell after the fact. So typically how it works at a high level is we would normally let a loan charge off and then sell and release servicing to a debt settlement company or another investor for low double-digit pennies on the dollar. In this late-stage delinquency sales structure, we were able to retain servicing and portions of the recovery, which will result in nearly double the returns we would have otherwise been able to achieve.
Our final question comes from Jill Shea of UBS. Jill, please go ahead.
Thanks. Good morning. So I just wanted to touch on operating expenses and just wondering if you could highlight any opportunities there and the largest efficiency gain areas. And then also, how does continued brand awareness improvement impact your sales and marketing spend?
Yeah, so I'll hit on some of the operating expense lines. I'll let Anthony hit on the brand awareness. But overall, we saw meaningful improvements across all functional expense line items. Sales and marketing specifically was down about 900 basis points year over year as a result of obviously improvements in overall brand awareness, continued and elevated cross-buy. We're close to 40% of all new products that were taken out in the period were coming from existing members on the platform. And then we're just getting much more efficient at being able to market it. In terms of other efficiencies, we continue to see efficiencies in R&D as a result of the migration from being on-prem to the cloud in our tech platform business, as well as other investments that we've made over the course of the years that are starting to play out. On the operations side, we're seeing meaningful leverage as a result of some of the automation efforts that we've invested in over the course of the last 24 months, which again are starting to play out as we're seeing better funnel conversion and improvement. And then in G&A, as you would expect, there's meaningful operating leverage in the system as we continue to scale. We made significant investments as we became a public company and got our bank charter, and also invested heavily in risk and second and third lines of defense. And as those investments were made, over the course of the last 12 to 24 months at scale. I'll turn it over to Anthony to hit on the brand piece.
Yeah, on the brand awareness side, we're really pleased with just the continued improvement we have in unaided brand awareness. Our marketing team and our businesses have done a great job of putting together a very integrated multimedia strategy that leverages partnerships with big, well-known brands that help us achieve unaided brand awareness to become a household brand name. That helps improve our overall performance marketing as well. The more people that know us, the more people that trust us, the better reaction we get from every offer we have in the marketplace or other ways that we connect with potential new members, in addition to building their awareness of new products beyond their initial product. Our cross-buying continues to remain really strong, and we're seeing good financial service productivity leverage in our customer acquisition costs. So it's been a great year, and 2024 is off to a great start as it relates to the impact on unaided brand awareness from things like our recent partnership with the NBA as the official bank of the National Basketball Association.
Oh
With that, let
boy.
me add some concluding remarks.
Oh my God.
I want to thank everyone for joining us today. We're proud to kick off 2024 with an exceptionally strong first quarter. Our 26% revenue growth, driven by 54% growth in revenue from the combined tech platform and financial services, which now constitutes 42% of revenue, while no growth in lending, gives us a very strong outlook for the year, with 25% EBITDA margins in the quarter and for the full year. Record $3 billion of deposit growth and 16% growth in tangible book value, and 44% growth in members, now totaling 8.1 million in total, are a great testament to the success of our bold strategy and ability to execute across an unprecedented set of financial conditions over the last 6 years. Although we live in an unpredictable world, our team at SoFi is resolved to serve the needs of our more than 8 million members and clients while sustaining the growth, profitability, and increasing the shareholder value that we've done so far. We thank you for your interest and look forward to talking to you next quarter.
Goodbye.
This concludes today's call.
What the fuck was that? Like, can someone tell me what was that? Like, seriously, what was that? The most uninspired call I have heard all earnings season, and we've had about 2 weeks of earnings so far, almost basically 3 weeks. What was that? Like, I don't know if the guys were staring at their stock while they were talking and they felt like bad or something, but I don't understand why someone would ask a question and they would start reading a slide off a PowerPoint as if like people needed to hear more numbers after 20 minutes of them talking about numbers. I don't get it, dude. That felt like PayPal last quarter, where Alex Chris basically didn't have any vision. Down 5% right now. I can't blame the market for dropping it 5%. I really can't. And remember, at the beginning of this market open, we got to one slide in the deck. And this one slide is where my excitement, unfortunately, started to become less exciting. And that one slide, I'll share with you guys right now, is this guidance slide. That just wasn't what we were looking for. So GAAP net income is 10 million. I found out, by the way, during the call, why the GAAP net income. So they put up $88 million this quarter. We came to this slide 10 minutes into the stream, and I was like, why is the GAAP net income going to be $77 million lower? By the way, on the high side, the low side might be 5 million next quarter. It's because the 88 million they put up this quarter, 59 million out of that 89 million was a one-time charge-off due to the convertible debt exchange that they did back in what did they do back like 2 months ago, right? Or a month ago. Sorry if the internet's bad, guys. It should be getting pretty good in a second. Let me just exit out some of these tabs and the internet should be fine. Let's make sure this doesn't break or anything. And so that's kind of the problem that we're seeing right now, right? They're also only guiding for 17% growth. That is a sharp decline from 30% over the past few years. Deposits is the part that I think these 8 million members, dude, I don't think they're active. I don't know how you have 8 million members and you only have 3 billion in deposits a quarter. For context, Robinhood has 3 billion, over 3 billion a month. How is SoFi getting 3 billion a quarter? What's going on there? What's happening? Now, I know Robinhood has 23 million members, SoFi has 8 million members, but at the end of the day, Robinhood is perceived as this like childish app where people are only depositing a couple $1,000s here and there. How are these guys getting close to 4 billion a month? Last quarter was 3.7 billion. But SoFi, who has sophisticated 744 FICO members, right? Like like you have to actually apply to get a loan from these guys. How are they only depositing $1 billion a month? It means that these 8 million members, there's no way 8 million people are depositing every month from direct deposits, since 90% of direct deposits. It has to be lower than that. Like I would imagine maybe 2 million. that is lower. The tech platform is growing 21% year over year, but the overall revenue is only growing on the high side 17% year over year. So the tech side of the business has better margins, but it's not uniquely helping to grow the overall business. I think that's the core problem. That's one of the core problems we're seeing right now. I just got a text from Steve. I don't know if he's I'm going to text him if have you seen SoFi earnings? He just texted me his new article about Meta. Steve, we're trying to save this fucking SoFi company. Goodness gracious. Oh my gosh. Oh my gosh. So that's the problem that I'm seeing right now in earnings. Okay, he saw it. I'm going to give him a call. Let's see if he picks up. Let's see if we get some raw reactions from him. But that's the problem that I'm seeing right now in the context of SoFi. It's not as pretty as we want it to see. Let's go back to this tab right here. Yeah, he can't pick up. So the member growth is great. Adjusted EBITDA is great. Revenue is fine. GAAP profitability is fine. The problem is this slide, Galileo, is also growing, but it's just not growing as hard as it needs to grow. 20% year over year is amazing, but at this point, the street just wants a little bit too much more in order for this to grow. Remember, I was on the phone with Steve on the market close on Friday, and I said, Steve, I asked him a very specific question. Steve, if SoFi did not have Galileo or Technesis, which are the B2B banking payments API companies that they acquired and event, like that's kind of the core AWS of fintech narrative. I said, if they didn't have those parts, would you be excited about SoFi? His answer was no, because at that point, there's no difference between them and something like Ally Bank, right? The thesis is not really exciting at that point. I would have to agree. And, I've been saying that over the past couple of weeks. My assumption was that maybe they announced something on the B2B side that's going to be exciting. Joshua says they raised guidance. The problem is their raising of guidance is still lower than what they've historically done over the past 2 years. And that's why the street's getting a little concerned right now. Tesla, by the way, up 14%. So we're seeing a lot of momentum in Tesla. We'll talk more about them in a second. But that is the problem with SoFi. Again, I still think the fair value is $9 or $10. If any other company does a triple beat like that, it would be up 12% in the pre-market. It is shocking that they're down 4.5%. And what's worse is that call, let me know if you disagree, but it was the most uninspiring earnings call I've heard this whole season. I just cannot believe how bad that call was. Like Noto did not sound like he's running the greatest bank in the world that's going to take over the JP Morgans and like he wants people to get excited. He just didn't sound like that. Yet. If you're holding this for the long term, I don't think it's a big deal. If you are looking to exit at like $9 or $10, I don't know if we're getting that today. If you are holding this for like 20, 30, then like really this doesn't even matter, quite frankly. And I think SoFi will be fine over the next 10 years. The overall growth, even if it's valued as a bank, will allow it to grow. But if you're someone like me that wanted a $9 pump on today specifically, I don't think I'm getting that. I don't think a lot of people are getting that. But if you're long, then there's nothing in this report that says you shouldn't buy the dip if you're long. I'm just not super long, so it's just the difference of time frames here as well, which is okay. But that's one thing to remember when it comes to SoFi. We got Michael Anthony buying another 20,000 shares this morning. Get back in at 650. I mean, I don't know if it gets below 7, but we'll see. Now, the odds of this thing running after earnings, I don't think is that, or running into the market open, I don't think is that far off. I think it could run. It's just pre-market action tends to dictate a majority of the time the market action as soon as the market opens. I mean, yeah, there are some deviations here and there, but if something's green in the pre-market, it tends to be, unless there's a lot of macro stuff, relatively green. If it's not as green, if it's red, it tends to sell off a bit. Could this 5% down turn into 5% up? Maybe, but then it wouldn't even be 5% up from where we closed on Friday. It would be 5% up from 750, which, would still not be that high. So I guess we'll see. The other thing that happened, Data-Driven Investing posted this right now on Twitter, is that they are declining in their quarter over quarter growth from the lending and tech side of the platform. So let me pull this up right here. He says, raw thoughts after briefly reviewing the numbers. Headline numbers look great, but the underlying figures are not as good. Lending and tech platform are both down quarter over quarter, and the difference in revenue is made up by corporate revenue, which is something of a black box. He's right about that, almost like net interest income, right? I want to see consistent growth in the tech platform, especially. I'm not listening to the call until later, but I'll be very curious. The reason he says consistent growth in the tech platform is because SoFi is just a bank without growth in the tech platform, right? This is what, and he's a very big SoFi bull, and he's saying this. This is the part of the SoFi thesis that I think everyone has to understand, including myself even more and more, that if this thing doesn't grow, it's a bank. SoFi's let's just do this right here. SoFi price to book. SoFi price to book. Let's do what is SoFi price to book. This generative Google thing is really good, by the way. It's generating it really quickly. 1.47. Okay, that's their price to book. What is JP Morgan price to book? 1.81. You know, it's in line even at this price. What is Wells Fargo price to book? And price to book is one of the core ways you value a bank, because it's really a question of their tangible their tangible loans and the tangible book value is likely influenced. I mean, it's mainly influenced by the value of their loans on their balance sheet. Wells Fargo, 1.29. SoFi is even valued higher than Wells Fargo, and it's obviously not as profitable as Wells Fargo. What is Bank of America price to book? So SoFi's price to book is in line as a bank. Price to book of Bank of America is 1. It's lower than SoFi. The tech side of the business is what gives the multiple, and the tech side of the business is not growing at that level yet. It's just not growing at that level yet. All right, so that's what we got in the world of SoFi. If you are just joining, we're going to transition to other news in the market open. We got 20 minutes left until we get into the market open. It's going to be a really exciting one to see today. But the big news right now in the context of SoFi is that they triple beat. The beat is a little financially engineered in the context of how strong their net income is, given they have a $59 million one-time charge-off due to the convertible debt. And as a result of that, it's making the numbers look good, but the numbers aren't as amazing as we think. And the street's obviously reflecting in that by showing, less progress in the numbers. So that's what we got on SoFi. Let's talk to Tesla. And let's see what happens. So Benny says, Amit, do you think Tesla sells off? Let's ask the entire question into the chat. Do we think Tesla sells off? Tesla right now, 13.39% of the pre-market. If I had to guess, I would say no. I don't think Tesla sells off. I think this is pretty big news in the context of what's going on with Tesla. Let me pull up the chart one more time. And it would be hard for me to see. Now, look, it's run a lot. So, do people take profits? Is there, or is there some exit liquidity going on today? Sure. So, could we get a short? But does it go down 13% after going up 13%? I don't think so. I think the momentum here today is pretty damn exciting, and that's why the street is interested in what could happen to Tesla. Jessley absolutely killed it with the Tesla call. Shout out to the Tesla hits. Yeah, if you had Tesla leaps, especially those 330 leaps, you've been doing very well, and you should be up substantially now because the thing's getting a lot closer to 300, 330. And if you had leaps, then you don't even have to worry because you still have so much time for this to develop, right? So you can sell and take profits, but even if you don't, it's not like it's going to tank tomorrow because your expiration is not for 2024. So Tesla right now up 13.3% at $190. Again, the reason for why it's doing the way it's doing is because Elon went to China over the weekend, and they signed a partnership with Baidu, which is Google's version of China, or China's version of Google. And the partnership is going to map out a strategic architecture and framework for deploying the mapping of the data that is required to deploy something like FSD. Again, in the United States, Tesla is taking all these different cars on the road, getting the video sensors and training their neural nets. China is a different world, right? There's a whole different landscape of how you drive on the roads. And as a result of that, you need a technology partner to be able to help you condense all that data. That would be Baidu. China's probably very happy about that because Baidu is getting more business. I would imagine there's some type of revenue share there as well. And then Tesla is actually working with Chinese companies, which is what Xi Jinping wants in order for Tesla to stay in the region, right? And not just be fully autonomous, no pun intended, by itself, which is a really good thing in the context of China. And it doesn't affect American consumers. The data is Chinese data. It's not American data. So I think that from that security perspective, it's good. And so the street's like, well, fuck it. If that's the case, let's buy this up right now because there's no reason it's not going harder. I think the one key thing about what's happening with Tesla is that it was sold off aggressively year to date, and sentiment can change very quickly. And the sentiment that changes that we got right now is that FSD is real. And if that FSD sentiment has changed for the better, maybe Tesla sustains itself and potentially even goes to 200. Here's Dan Ives talking about what's going on with Tesla.
What about China tech versus U.S. tech?
Look, I think right now U.S. tech's ahead of China. When we talk about AI, I think with Tesla, they're trying to thread the needle here. They're trying to take that technology, even though Baidu, it's stored in Shanghai, to actually be able to use that globally. And I think it just comes down to there's only two companies that have been able to thread the needle in terms of China, U.S. It's Cook and Cupertino, and it's Musk and Tesla. And that's why this is a huge win for Musk, even domestically, for him just to come in there during the auto show, come out, get FSD approval.
So Dan, let's stress test that a little bit more. Apple, China right now, not even a top 2 smartphone player. Dan, can we get into that a little bit more? What Jay is making, the point that he's making, is that ultimately the Chinese market will be dominated by Chinese brands, potentially in EVs and likewise in smartphones. Why is he wrong?
Because you make the best products in the world, consumers are going to buy them. And that's why at the top of that mountain, the Mount Rushmore, it's Cook and Cupertino. Now, they're clearly going through growth headwinds now, but I believe 6 to 12 months from now, they're not. I think we'll start to see that Thursday when they report. Look, I think this starts betting against Apple in China has been the wrong move. And in our opinion, it's 220 million iPhones there. 130 million have not upgraded in 4+ years. That growth opportunity will be on the horizon.
We'll talk more about Apple in a bit. I'm very curious to see what's going to happen on their earnings. We'll also do an earnings preview because let me just show you guys the calendar. The calendar is crazy. But what he said right there is that Musk in China and Apple in Musk from Tesla in China and Apple and Cupertino, right? Cook and Cupertino in China. Those are the two guys that actually have a stranglehold on the country. Google's not in China. Meta's not in China. Elon's in China. And he's been very sophisticated of a business operator in China, right? When he talks about free speech, he conveniently makes sure not to, say things about the Chinese government. And I don't blame him, dude. People call him a hypocrite. Short. Oh, well, sometimes you got to be hypocritical in business. You got to make sure shareholders get that return. And if 25% of your sales are in China, then yeah, you're going to be a little hypocritical. It is what it is. But he does what he needs to do to get the Chinese government on his side. And then Apple obviously has done a phenomenal job there. The problem with Apple has been iPhone, slowing sales, but Dan Ives believes that the opportunity is going to be vast for the upgrade cycle. And so that's what we're seeing right now in the context of Apple and Tesla. I wanted to pull up something right here. Oh yeah, here's the earnings calendar. So this week is going to be a hell of a week. Tomorrow we'll be live at 8:15. SoFi's down 6.5%. Oh boy, we'll go back to SoFi in a bit. But this week's going to be important. Tomorrow I'll be live at 8:15 for PayPal. So we'll do PayPal tomorrow as well. We'll see what's going on with PayPal. SoFi. Oh, Domino's was today. Let's look at Domino's. Domino's stock, DPZ. Domino's is up 5%. There you go. Not bad. Domino's is up 5%. I don't know the numbers. I had a feeling it would go up. I wrote it in this long post. Shout out to anyone who reads these every Sunday. I publish a very long essay on just all the stuff I'm thinking about. I'll put this in the chat if anyone wants to read the earnings preview. But one of the reasons I said Domino's would go up is because the stock's up 20% year to date, but people keep eating pizza. And if the consumer's strong because everyone has jobs, then ordering pizza here and there shouldn't be something that breaks the bank for consumers, which is why, ironically, it should show the consumer's healthy enough. It's not healthy to eat pizza, but you get what I'm saying, to keep buying Domino's. So Domino's, we got up 5%. That's amazing. We got Pinterest this week, Pfizer this week. They have some new gene therapy vaccine that was approved. We'll see if this can bounce from the bottoms. Hershey's, the price of cacao is up. Pinterest, it's down 6% year to date. Google was supposed to buy them. That's not happening. Sirius, Buffett bought them. Then you have Apple, Amazon, Coinbase, PayPal, and SoFi. I wrote a lot on SoFi, and unfortunately, basically everything I wrote, none of it really happened. What I was looking for, everything happened, but the B2B tech side of the business didn't happen. That's the only part I cared about today. And none of that ended up coming true. So yeah, pizza's more better than an online bank. It's incredible. It's incredible. For those that are just joining, like Dennis, wasn't SoFi triple beat? Yes, but some of the numbers were a little manipulated due to the fact that they had some one-time charge-offs due to the convertible debt. And as a result of that, SoFi right now down 5%. The street's basically not buying their financial engineering, and guidance is higher, but not as high, along with lending and the tech platform slowing down quarter over quarter, even if it's up year over year, which is the problem. And so that's the issue. That's the issue we have right now in the context of SoFi. Cal says PayPal. Yeah, definitely we got some PayPal here in the context of PayPal. Did we figure out the secret company Buffett was buying? It's SiriusXM pretty much. It's up 351% year over year. So it seems like SiriusXM is the one that's up. Matt says, please say Amazon and PayPal are going to shit the bed. Matt, the problem with that is that I think Amazon is going to be a little bit better due to those cloud numbers that came out from Google and Microsoft, right? Google and Microsoft had amazing numbers on cloud, so Amazon shouldn't have bad numbers on cloud. PayPal, I don't know. Quite frankly, I have no idea what PayPal is going to do. I think PayPal should be good, but then again, if their new innovations did not, uniquely innovate this cycle, then maybe PayPal is not that exciting. But I think Amazon should be fine. Apple's the one I'm more worried about because, the Vision Pro now is declining in terms of its its relevancy. They went from 850,000 to 450,000 in terms of production. Also, a bunch of articles are saying Apple might not produce a Vision Pro in 2025 if the demand doesn't pick up. And I personally do not see how demand's picking up for Vision Pro. Like, I just don't know who's going out there rushing to buy this $4,000 device. Already putting it at 4,000 was a ridiculous price. And then saying, people are going to buy it because it's Apple, and the Quest 3 is, just, it's not as sexy as, like, yeah, you're right about that, but 4,000 is 4,000. So tough to see how that's going to play out. What else do we have? Sitting on SoFi options. Okay, so the SoFi options I have today are for let me show you them right now. They're for $17, $20 spreads. And honestly, I don't know how much they're going to be crushed, quite frankly, because I bought them lower than the price SoFi is at right now. So I wanted these to do better today. Right here, you can see they're up 10%. They're probably going to be down 10% as soon as the market opens, or they're flat. I'm not crazy about exiting these at break even. I have plenty of time, so I'm not going to take a loss on these. If I have to sit on these, I have to sit on these. I don't really care. But I bought them at 680. So I think at one point SoFi will be, 790, 780, and I'll be able to exit these relatively easily. Right now, SoFi 749. We'll see what happens when the market opens. But the goal was to get this thing to $9 today, and I would have made 40 or 50% on these. Seems like that's not going to happen. Thankfully, these are leaps, and so we have plenty of time. These are not going to expire tomorrow, so that's okay. But it does seem like we're going to be in a tough situation for SoFi. I still think $12 by the end of the year is possible, but now as we look at the guidance does not look like anything's going to be exciting on the B2B tech side, which begs the question, why would SoFi go higher, right? Like, what is the catalyst to get this thing to pop up? It's also 18% sold short. This pre-market action is going to get the shorts to double down. They're not going to be afraid of covering their shorts. And that's one of the things I was saying over the past 2 weeks, that Noto needs to make the shorts feel scared for shorting the stock. I mean, say whatever you want about Alex Karp, but Karp made the shorts scared, right? He said they were high on cocaine. I mean, he really made them think that this company's crazy, the CEO is crazy, he's going to pull a rabbit out of his hat, which he's done many times. And so the shorts aren't messing with Palantir. The short float on Palantir is 77 million shares out of 2.1 billion. SoFi, it's 180 million shares out of 959 million. It's a bit ridiculous right now. So I don't think Noto's a weak CEO. I don't think Noto's a weak CEO. I think Noto's a phenomenal CEO, but this earnings presentation was a bit weak to me because, dude, it wouldn't kill you to sound a little excited and just sound like you're running an $8 billion company, which, I presume no one in the chat has had the opportunity to run an $8 billion public company. Dude, you are Anthony mother effing Noto. You gotta bang the table a little bit. This is what Karp was when Palantir was at $6 and Karp was getting these ridiculous questions by analysts. He banged on the table, which everyone said was unprofessional, but that's because there was some passion. At the end of the day, you want someone to care. You want them to actually give a shit. And I did not feel that Noto gave a shit on this call. I really didn't feel that. And neither did I feel the CFO gave a shit. And the market's reflecting that right now, down 4%. MicroStrategies also tonight. That's going to be a big one. Bitcoin has been struggling a lot. The inflows have been disgusting on the ETF. And so that's why Bitcoin's not really doing that good right now. So we got crypto right here. Bitcoin, 62,483, up 0.28%. Really just not having a lot of momentum. After the halving event, Bitcoin tends to fall off. We know that tends to happen most of the time. So maybe it'll take a little time before Bitcoin starts to show momentum. But that is another thing, that MicroStrategy might not have the best earnings today, given that Bitcoin is down a little bit. But their FASB rules, if those go into effect, then we're going to see a lot more. We're going to see a crazy earnings per share, right? Because the profits, they have 8 billion in profits. They're going to be able to show that on their earnings if the FASB rules go into effect, which could get people excited. But Bitcoin's down, so I don't know how excited people would be. Gotta agree. Seems like shareholders have more passion. Yeah. And I know, Adam, I know you are a big shareholder in SoFi. It is kind of sad that shareholders have more passion. I mean, there are dedicated channels on YouTube to SoFi, and the company is not excited on earnings. It's sad, dude. It's very, very sad. It really is. And is it a thesis breaker? No, if you're holding for the long term. But it's not about long term or short term as well. It's about, this stock's been in the gutter. It's down 20% year to date, and it's been stuck at single digits. I remember buying this thing at $4 or $5 back in May of 2023. Not much has changed outside of a couple of pumps due to some Jerome Powell potential Fed cuts that never happened back in August of 2023. So I don't know. It's tough. It's tough to see it. Thank you, everybody, for being here today on the Market Open. Really appreciate you guys. We got 6 minutes until the Market Open begins. I just want to give a quick shout out to someone who messaged me over the weekend. His name is Krishna. Krishna, if you're watching, let me know in the chat. But Krishna and his wife, Mevi, they say they watch the channel every single day in San Francisco. They turn it on at 5:45 a.m. every single morning. They say we absolutely love it. We watch it once we come back from the gym every morning. And we watch because of a pragmatic approach that you have towards analysis, hopefully not having too much bias. And also, and he said this, because of your humor. And he gave me a winky face. I don't know if the winky face when he said that is, haha, I'm being sarcastic, or it's like, no, we actually like your humor. I'm going to assume it's the latter. And so shout out to these guys watching the market open every single day. Let's get an update as well from Bank of America on their price target for the S&P 500. And then let's watch a little bit of that going into the market open in about 5 minutes. All right, here we go.
Savita Subramanian, head of U.S. equity and quantitative strategy at
98 or 96% of that bell curve is, all the rest of the scenarios that are more likely to happen. And I think that what investors may not be appreciating is that the economy is actually doing okay. Maybe it's slowing a little bit from last year because of things like fiscal impulse and, other factors, but consumption is still healthy. People are still gainfully employed. The layoff cycle seems like it's not necessarily amplifying. I mean, so far during this earnings season, we've heard some layoffs, but nothing to write home about. So I still feel like we're in a spot that's, kind of a glass half full view.
About a month ago, I think, it's crazy. I've got it in the notes here that they found it. Big argument between two Bank of America strategists. So you got Michael Hartnett, your guy who's head of investment, and you, who's head of the quantitative strategy.
US equities,
Okay.
Yeah.
So you were saying things really are not that euphoric yet. He was thinking he was saying you're starting to see some euphoria manifested in the Magnificent Seven.
Right.
So he may have been on to something in terms of this recent pullback. But you're still say there's still now there's even less euphoria than when that article.
Exactly. I mean, the Magnificent Seven was crowded. That was not our favorite place to be. We were underweight information technology heading into this year. For a couple of months, that was not the right call, but it's starting to play through. But I think the idea is there's more in the market besides AI CapEx takers. There's more to the S&P 500 than just semiconductors and software companies and, Meta and these, mega cap tech companies. And I think what's happening now is we're seeing the market broaden out and other companies are starting to beat earnings expectations and rally, but the Magnificent Seven is kind of dragging everything down. Maybe that continues a little bit longer, but I do think that we're in an environment where the health of the consumer and the corporate is still not imperiled by anything we're seeing in the macro data.
Speaking of macro data, let's look at a couple things right now. The 10-year on the U.S. Treasuries is lower today, so that's nice, 4.64. Again, getting that thing back to 4.3 would be really nice for equities. Probably not going to happen for a while. But if that does happen, that's good. Oil prices, let's check a look on that. Oh, we got them down. There we go. Nice to see. Oil is continuing to tread down. We got to get below 80, I think, for some inflation data to get more exciting. But oil is down 0.62%, which is nice. And then the 10-year is down today as well. We're going to really have to see the 10-year start to go a little bit lower for equities to do well. Google and Microsoft killed it. Let's not forget, Google and Microsoft absolutely killed it, which is why we saw some good momentum there as soon as the market opened. Or sorry, last week. But we're going to have to see today if that market momentum can continue to do what it needs to do as we see how the market, continues to rally. So what do we got right here? SoFi at 731. Okay, so so what do we have? We're down 6.3% on SoFi. Palantir 2252, we're up 1.15%. Robinhood 1788 right now. It's down 0.11%. The reason why Robinhood's down is I think primarily because of the Bitcoin falling a little bit. Again, still pegged a little bit to Bitcoin. Snapchat's down 1%. It was up 30% last week. Where's Google? I forgot about that one. We got to look at Google. Google's down 2%. Okay, Google down 2%. Not that crazy. It was up 10% last week. Makes sense that it is taking a little bit of a sell-off. But SoFi here, we got the market open in 50 seconds. SoFi here, this is the one we're going to look at. as soon as the bell opens and see what we got going on. If you're new here, I do ring a bell as soon as the market opens. So I'm giving you a warning right now. If you already had enough coffee and you don't need to wake up more, you can cover your ears in 30 seconds. But we're going to ring the bell and we'll see what we can do. $9 billion left the money market funds last week. So nothing too crazy. We'll see this week, 2 weeks after taxes, what money markets look like. But in terms of the macro, things seem to be going okay. The Fed has a decision this week on Wednesday. We'll be covering that. SoFi in 13 seconds is going to have to make a decision on if it goes higher or lower. Lawyer? Do I need a lawyer or lower? Oh boy, here we go. All right, 9:30 a.m. Monday, April 29th. The stock market is now open. Okay, SoFi opens red, down 7% on the day. Yada, yada. That's what we're seeing right now with SoFi. That's what we're seeing right now for SoFi. Down 7%. Ironically, my calls are still green, so not too bad on the calls. And again, we got them when they were pretty cheap, so calls are okay. You guys can see this right here. They're still green. We're still up 5%. Probably will be able to exit those. It's just sad because the whole idea of these calls was now they're up 1%. The whole idea of the calls was to make some money. And it looks like that's not happening. 7.2% right now on SoFi. Let me pull this up again real quick. So that's what we're seeing right now in the context of SoFi. And again, for those that are just joining that are confused, the profitability was not as profitable as the headline numbers suggest. And the guidance also wasn't as amazing as one could think the guidance was. Recovering a little bit right now. We have a little bit of a green candle, 6% right here at 738 on SoFi. Google 171, Apple 181, Nvidia 870. Nvidia, Jensen Huang was just on the what was he on 60 Minutes last night. So that was nice to see. Tesla 186. So Tesla falls from 190 to 186 as soon as the market opens. Still up 10%. I mean, it's just absolutely incredible. The fact it's up basically 25% over the past couple weeks right now, ever since that earnings, basically since the last week when it bottomed at 138. So Tesla we got at 185. Snapchat 14.29. Ginkgo 87 cents. Palantir 22.82. Robinhood 18.09. Nice green candle on Robinhood. Oh my, 18.14. 18.14 on Robinhood. Not bad at all for Robinhood. Again, for a little bit of context, Robinhood does $3 billion of deposits a month. SoFi is doing $3 billion a quarter. I don't say that to be negative against SoFi, just to give a little bit of a contextual analysis for why one fintech product is gaining momentum with users, and the other one, even though it says it's gaining momentum, the numbers aren't really proving that it's gaining momentum. And at the end of the day, product really does matter. And SoFi's product is just not as substantial compared to a company like Robinhood, in my opinion. And so I think that's where we're seeing some of the problems right now. It's up 1.73%. Robinhood does have earnings in about a week, so maybe the street's going to get a little excited as we get into Robinhood earnings. Palantir's 23. There we go. Palantir 23. There we go. Palantir 23. Not bad at all for Palantir. I bought about 30 shares last Friday on Palantir, just adding to a little bit of the position going into earnings. Robinhood 18.25, Palantir 23.01. Not bad at all. Not bad at all. Nice to see Palantir's at that $23 range. Robinhood 18.22. Meta's at 437. Meta's down about 1.29%. Sirius XM up 1.99%. S&P 500 is green, folks. S&P 500 is green, 0.46% right now on the S&P. We're at 510 on the S&P. NEO's at 4.6. That's up 3%. Shout out to those who own NEO. The stock's been in the gutter, so nice to see NEO getting a little bit of love. Alibaba's at 141. Not that bad for Alibaba, or not 141. Sorry, Royal Caribbean's at 141. If Alibaba was at 141, that would be a little crazy. SoFi here, 723 now, down 8%. Yes, my screen is a bit glitchy, guys. What I'm going to try to do right here real quick is fix this. And the way to fix this is I just have to restart my Mac. So what I'm going to do is I'm going to play one clip from CNBC. It'll literally take 2 minutes. And I should be able to reset my Mac and reset just means I have to turn it off and on. I don't know why it's being stupid right now. So let me see if I can just play one thing real quick. Let's take just a couple more minutes and then I'll play that just to get a little bit more action. I'm sorry that it's laggy right now. It's being stupid, dude. It's being as stupid as the stock. SoFi's down 8.8%. 8.8%. What if SoFi got under 6 today? I don't think it's under 6, but under 7. I mean, yeah, that could happen. That very much could happen. Google at 170, Amazon 182, Nvidia at 870, Tesla 187. It's pretty disgusting, dude. Robinhood 1817, Palantir 2298. So Robinhood, I think, getting a bump before earnings. The street kind of knows what's going to happen, and they're getting excited for that. SoFi 8% down on the day. Quite incredible. Quite incredible. Absolutely brutal. It is pretty damn brutal. Is Shopify were 3%. All right, that's good. So me and TJ sold some Shopify puts. So that's getting some momentum here. And so we got Shopify up 3% right now, 73.63. Apple pumping a little bit before earnings. Okay, let's go to Apple. Where is Apple right now? Apple 174.43. Really interesting. Wow, Apple's actually up 3%. Wow, Apple was stuck over the past. Oh no, my Mac's working. Oh, perfect. Guys, it's working. It's working. Yes, let's go. Let's go. Perfect. All right, we got the real Weeble set up. It wasn't working for like 20 minutes during the call. Here we go. There's no more lag. Now we can go through all these stocks. I was using my second computer. There we go. Perfect. All right, we're back in motion. Tesla 187 up 11%. SoFi down 8%. SLG Office REIT we talked about on Friday up 2.7%. Apple 174 up 3%. Palantir 2291. Shake Shack up 0.25%. PayPal. Wow, PayPal's up 1.39. PayPal might get to 67 today. PayPal might get to 67. Not bad. Claudina says, I sold SoFi. I will take my loss. All right. So we got some people selling their SoFi. Meta's dipping today. Where's Meta? Meta's at 437. SoFi 718. Goodness gracious. The calls I have now are down 12%. So we're down $600 on these calls. Nothing crazy, but again, we'll see what it turns out towards the end of the day. I wonder if anyone will step in to buy the dip. SoFi down 8%. Absolutely disgusting, dude. Absolutely disgusting. Apple 174. The Apple pump is kind of weird to me. I don't know why there's an Apple pump. Probably before earnings. Some traders are getting in before the pump. I really don't know how Apple's earnings is going to go. Everything tells me it's going to go negative, which is why it probably will go positive. But for what I'm looking at, there's not a lot of momentum going into the earnings. Robin right here, 1805. Colorblind Collector is all out of SoFi as well. Kathy Wood did buy a crap ton of SoFi. That did happen over the past 2 weeks. Or past 3 weeks. I think she has close to 7 million shares of SoFi. A little bit more than 7 million. She has a decent amount of SoFi. So that one is down. Oh yeah, the OpenAI talks with Apple is interesting, but I kind of thought that was bearish. If they're partnering with OpenAI, it kind of makes me feel like they don't have anything of their own. So I don't know. I wasn't super bullish on that. PayPal right here, 66.93, 7 cents away from what we're looking for, which is 67.68. Robin, it's still 1801. Palantir 22.89. Palantir has some nice resistance at 23. We'll see if after earnings it can crush through that, which I think it can. By the way, I had a dream, dude. I had a crazy dream. I had a dream that I was doing a podcast with Shyam Sankar, the CTO of Palantir. SoFi right now, 707. I know how crazy that dream sounds, but I literally went to his house and we did a podcast. I'm not making this up either. It was the weirdest dream ever. And his wife was there and she was like making us food. It was so weird, dude. Like I think I took some melatonin last night, and the melatonin will put up some crazy dreams. And you know what happened? I probably read one of Shyam Sankar's tweets right before sleeping, and like with melatonin, like as soon as you see something before you go to sleep, it kind of ends up in your subconscious. So that was kind of weird, but nonetheless, not weirder than SoFi going down 10%. This thing's about to hit below $7. This thing's about to hit below $7, dude. Look at curly-haired twin sisters. My SoFi puts are printing. All right, curly-haired twin sisters. You should have let us know you got some SoFi puts. You didn't fill us in on the alpha here. Fucking bought some puts and didn't let the chat know. SoFi 5 cents away from $7, dude. What does she make us for food? She made us some Indian food. Come on, dude. Shyam Sankar. I think he's Indian from my understanding, so she made us some Indian food. I'm so serious, dude. And there was like a birthday party going on. It was the weirdest dream. It was a weird dream, dude. I just woke up like, what the fuck did I just? Oh yeah, SoFi earnings, and then I transitioned my mind to SoFi, and I saw the thing was at 834. I was like, oh great, we finally got a little pump, and then here you go, down 10.5%. This is bad, dude. This is bad. Where's Tesla? Tesla 188. Shout out to people who got Tesla at 140. Congratulations. Tesla up 11%. It's not easy. Market cap today on Tesla, $599 billion. They just added $50 billion to their market cap. $50 billion to their market cap. SoFi's 1 cent away from 7. 1 cent away from below 7. Oh my God. Oh my God. Is this going below 7? Is this going below 7, dude? Is it going below 7? Is it going below 7? It looks, it's trying to hold the line at those 2 cents, but there's no buyers. There's no bid. Who's bringing in the bid for 7 or for below 7? Oh my goodness. SoFi is great for wheeling, as Michael Wilder says in the chat. My good friend TJ, he wheels the crap out of the stock. I think he had some amazing covered calls at 850, at 950. He had some cash grid puts at 650. So if SoFi stays stuck at like 7 to 720, he's going to print on the downside and the upside of the stock because it's not going to go above his covered call price. So he's going to keep the premium. It's not going to go below to his cash grid put strike price. He's going to keep the premium. TJ is going to make a shit ton of money off this. So it's a great stock to wheel. It's so far not been a great stock for capital appreciation at all. Tesla 189, Palantir 2267. Robin, it's probably falling down a little bit because Bitcoin's down. Robinhood 1797. Yep, that makes sense. IWM 199, that's up. Snowflake is down 0.27%. Roku's down, or Roku's up 5%. Roku's a beating after their earnings. Enphase 114, that's up. Elf, wow, 180. Elf continuing to get the momentum. Rocket Lab is up almost 1%. Uber's down. There was a good discussion on the Olin podcast around Uber versus Tesla for robotaxis. And it seems like Jason Calacanis, who's a long-term Uber investor, invested in their like pre-seed, believes that Uber will benefit off of robotaxis even more than, or not even more, but like just as much as Tesla. And some of the Tesla bulls do not feel that way. They think Uber is going to go bankrupt. So will be interesting to see how that story plays out as well. SoFi 1 cent away from 7. We're still not falling below 7. It's close to 6.99. June says problem with SoFi was everyone was looking to sell for a win. Yeah, but I also think the thing about SoFi is it was down 20% year to date. And so far, historically, in earnings, companies that have been down a lot have bounced up, i.e. Tesla. Companies that have been up a lot have bounced down, i.e. Meta. So I think we were just looking for it to follow the same pattern. And their numbers just weren't good enough, it seems like, to get that to go. Meta at 435. Meta falling because of the CapEx increase is probably the dumbest reason for Meta to go down. I think if you have Meta and you have a good averaging up, and like if you have a healthy margin of safety, if you have like a $200 average, it's not the craziest thing in the world because this was a stupid reason it came down. Remember, the Meta, Google, Microsoft, Amazon, these are the only companies in the world that can spend billions on CapEx and GPUs and AI infrastructure. They're the only companies in the world. So that means they're the only companies in the world that can maintain their moat because no one's going to compete with them for the amount of spending they have to do. By the way, Elon tweeted this over the weekend. I thought this was also another reason why the street's getting a little excited about Tesla. Tesla's going to be spending $10 billion this year just on AI infrastructure. Now, when you hear that, you may think, okay, these guys are already burning 2.5 billion a quarter. That's a lot of expenses that are going up. But look what he says. Any company not spending at this level and doing so efficiently cannot compete. I mean, he's right about that. GM is up 5% because they had some better margins. They sold some more cars, but they're not spending $10 billion on AI and inference or training and inference, which means if they're not doing that, how are they going to compete? What is the competitive moat across all these automotive companies if the future is self-driving and autonomous? If that's not the future, then yeah, Elon's wasting money. If that's the future, which at least today the street believes up 11%, that is the future, then it's not a waste of money. It is the most significant investment that a company could be doing to build out this vision. And we're seeing how that's going to play out. Meta, we're going to spend an extra $5 billion in investing on future growth. Stock market, let's wipe out $200 billion in valuation. Again, the market's stupid, right? This is where opportunity, like Robinhood dipped to $8 at one point. The market was stupid. Palantir was at $8. The market was stupid. I thought SoFi below $7 when I was buying it at $6.80 was the market being stupid, but apparently I was the one being stupid. SoFi right here down 10% on the day. Goodness gracious. This is a good question. Why give China all your research? Again, the reason they're up is because of the China partnership with Baidu. I think this is not a concern because giving China all the research is only going to affect cars in China. So even though Tesla's partnering with the Chinese company Baidu, which is China's Google, to build out FSD, which is why the stock is up 11% today, that is exclusive to China. It's not American FSD data going to China. And that American FSD data wouldn't even be valuable going to China because it's American, right? It's roads and bridges in America. So I actually think there's not even a big security concern. So, there's nothing to be super scared about. There's only positive news with this Tesla China article that came out today from Bloomberg. I don't see anything negative in it. The numbers on Tesla suck. Like we all can understand that operating margins down, revenues down, EPS down, but this is a story that is more qualitative than quantitative, it feels. And the qualitative part of the story is winning over the quantitative parts, as it should when a stock's down 40% year to date. I mean, you have to give people a reason to buy if the numbers aren't there. And it seems like that's the case. Meet Kevin just made 600,000 on Tesla calls. Yeah, I do think he had some short-term Tesla calls. And so he seems to be up on those short-term Tesla calls. And that's great for him. I mean, congrats. He's up a lot of money. That's good. Right timing on Tesla. Where's SoFi? Is it below 7? 706. 706, down 10%. Oh my gosh. Oh boy, where's Palantir? Where's Palantir? Where's Palantir today? Palantir 2260. Okay, so Palantir falling from that 23 pump. It was interesting. Palantir and Robinhood both pumped early morning. It seems like people are getting ready to buy before their earnings, which gives me a signal that these guys are going to get a lot closer to where they used to be going into earnings because the street's excited about them. And we'll see where it goes. We'll see where it goes. SoFi 707. Now, granted, look, if SoFi falls to 680, I'm going to buy more contracts. I mean, at the end of the day, those contracts are going to be worth like $15. I was paying $23. So I would happily buy more because eventually we're going to get a bounce. I mean, I'm objective enough to not be emotional here that this stock's going to be dead forever. I think there will be a bounce eventually. And because they're leaps, I have time to hold them. The question is the opportunity cost of that capital. Given I already bought the options relatively low, I don't think the opportunity cost of the capital should be high. Like even right now, yeah, we're down 3% on the options, right? So we have time for this to play out. But we got to see. We got to see if this thing can bounce. Now, the problem is the short flow. It's probably going to increase. That's the issue. SoFi bouncing a little bit right now, 711. Until the short float starts to decrease, I think the shorts are in control with this company. And that's the sad part right now about it. Which contracts do I have? $17, $20 call debit spreads for 2026. So I bought the $17 call, sold the $20 call. You might be saying, yo, that's super out of the money. I agree. But if you look at the delta relative to the price movement, if SoFi were to move up $2, those calls would be up about 70%. So to me, the goal was get this bitch to $9 and we're going to make some money today. But, everyone has a dream. And sometimes those dreams, like just like I wanted to be the next Michael Jackson, I had to realize that sometimes those dreams, they take a breather. They take a breather. Sometimes they take a breather of, a GAAP EPS of 59 million off of one-time $88 million charge, but nonetheless, they still take a breather. All right, we got Apple and Amazon this week. Let's get an update on what we're going to expect for these guys. I think Amazon will go good. Apple, not so sure, but Apple has been sold off, so we should get Apple hopefully having a little bit of a bounce. Let's get an update on there. CleanSpark's down 9%, and that's because Bitcoin is down 3% over the weekend.
After a big week of earnings, next we've got reports from Amazon and Apple still to come. Joining us right now is Ray Wang, Constellation Research founder and chairman. Hey, Ray, how are you?
Doing well. Good morning.
Good morning. Let's talk a little bit about what to expect this week, because we have two biggies this week in Amazon and Apple. What's riding on this? What do you think happens?
So on the Apple side, there's a decline in Vision Pro, but there's a good India story and hopefully an AI story starting to merge before Worldwide Developer Conference. But the cons are we might see drops in phone sales. China.
Real quick, that India story I think is getting overblown. It's not like the India. Yeah, they're having more manufacturing in India, but they're not taking over India yet. So investors really would have to stretch to see the India vision, which maybe they can stretch right now, but I don't think that's like a super big bullish thing just yet.
China and regulatory are the headwinds that are actually heading on them. And so you're going to see a weaker quarter for iPhone sales and margin expected to be up, but the AI story is the really one that's holding them down. And I think that's what people are looking for, but they're forecasting about $90.6 billion. Go ahead.
Yeah, you're right on that. And AT&T said the same thing, not just Apple, but Apple and Samsung phones. Consumers were kind of holding off on upgrading. So is that kind of where you're getting your expectation on that too?
Yeah, the checks are coming from there as well as suppliers. And I think what people are worried about is just a slower quarter on iPhone sales overall. But I think people are hoping that, some of the developments all the way working our way into Worldwide Developer Conference and some of the announcements that they're planning in the next few weeks will start sharing the AI story. There's rumors about how Gemini and Microsoft, Google and Gemini are going to be part of the generative AI piece in the next set of OS. And I think those are what's buoying the stock at the moment.
What about Amazon?
On the Amazon side, it's the pros. I mean, the cloud business is doing great. Ads are doing great. There's a CapEx benefit. They invested over $180 billion in the last cycle of CapEx, and we're starting to see the benefit of that right now. We looked at the Microsoft and Google Cloud numbers from last week, and they really show that there's a lot of growth coming there. And the ad business, I mean, we're talking almost $50 billion in ads for the year, and that they're the third largest digital ad player, kind of sneaking through, and most people haven't realized that. So there's a forecast of about $142.5 billion on this.
I agree with him. I think cloud's going to go great for Amazon, and for Apple, it's going to be a question of if they can sell the India story or if they can sell an AI story. But both of those are going to be hard to sell. SoFi right now 707, Robin at 1783, Meta 433, Tesla 188. Tesla's up 12% right now. Palantir 2267, and then Robinhood here 1782. Texas Roadhouse is up a little bit, and then Apple up 3.85% of the day. I feel like traders are getting excited for the stock. I don't know what the earnings will look like. You also don't want to see Apple up like 4% going into earnings because, I mean, you'd rather have it oversold than overbought, right? But let's see. Let's see how that ends up playing out. Why is SoFi dumping? Again, if you're just joining, they had a triple beat, but the numbers aren't exactly what they look like. 4 cents away from $7. A lot of it has to do with the convertible debt exchange. Lending is down quarter over quarter. Financial tech, like the tech platform's down quarter over quarter, even though year over year it's up. And so the street's just not excited. And on top of that, the earnings call was just horrible. Absolutely horrible. It was one of the worst earnings call I've heard this entire quarter. It was bad. Google 167. Google's now down 5% from or about 3% from the highs at 174 last week. So Google taking a breather. I think that's normal. Google did pump from 158 to 1.83, but mainly 174. Taking a breather here is very normal for Google. I think that's healthy. If Google's taking a breather, I'd imagine Amazon is taking, Amazon's flat, so kind of taking, but let's look at the Mag 7. Mag 7, everything's down except Tesla, Amazon, which is basically flat, and then Apple's up 4%. Meta's down, Google's down, Microsoft's down 2%. Microsoft just, their PE is just a little bit too high right now. And then Nvidia 857 down 2% as well. Nvidia was at 770 2 weeks ago, so not bad to see Nvidia here at that 800 level. The call was depressing. Yeah, I really don't think it was just me. The reason the call was bad, Kyle, is because there was no emotion and passion. You know, and some people may think that doesn't matter. That really does matter, dude. You need, at the end of the day, people buy companies that they're inspired in and that they buy from people they like to invest in. Like Karp is a likable guy. People want, Elon's a likable guy. He's a polarizing guy, but the people that like him really like him. Same thing as Alex Karp. Noto is just bland. I don't know if you love or hate him. He is who he is. And I get he's a different type of personality. You can't change who the guy is, but in the context of earnings, in the context of retail shareholder base that's desperate for some movement, he didn't even throw us a bone, quite frankly. And it was just not the type of earnings that I thought we would get. Thought it would be a little bit more exciting. You're always judging earnings calls on presentation. It's really about numbers in the long run. Correct. So, I mean, the reason why the stock's down today is because of the earnings call. The numbers over the long term on SoFi probably will be okay. But again, when we say long term, you know, with SoFi, we already know what the guidance is for this year. 1 cent away from going below 7. The guidance for this year is 175 million in net income and 17% year-over-year growth on revenue. Those aren't exciting numbers for a bank. And so long term has to be 5 to 10 years because it's definitely not the long term of the next 9 months because we know what those numbers are going to look like unless they're super sandbagging, which I don't know if they are, right? It's a tough macro environment for loans already. So yeah, earnings presentation just wasn't good. Remember, Palantir's numbers in the Q4, the numbers were very good, but there was one number that sucked, which was top line growth coming in at 19.9%. In order for Karp to still get people to buy stock, and the stock went up 30% at 1.50% after earnings, he came on that call and he said, "Hey, people are begging to work at the company." He said, "Hey, the demand we're seeing is making us think we need to hire thousands of more people just to keep up with the demand." He said little nuggets like this that tells shareholders that if he's not lying, if he's telling the objective truth, which what we're seeing so far in the past 3 months, it's been objectively true, given all the deals, presentations, boot camps, etc., that even if the number doesn't really reflect top line growth, it's coming. It's down the line. And Noto needed some type of nuggets like that here. And I feel like he was so rigid in what he was talking about. Maybe, his lawyers had the gun to his head or something. And I'm like, at this point, you got to let loose when the stock's down 20% year to date. I didn't feel that from Noto. Short sale restriction is on. That is correct. So once the stock's down 10%, the next day you're not allowed to short it. So the SSR rule is intact today. So I guess tomorrow will be a little bit of a relief, but still a bit tough. Still a bit tough. It sounded pre-recorded. Yeah, it did. It did indeed sound a little pre-recorded. All right, so that's what we got on SoFi. What other price action do we have? Meta at 433, Robin at 1767, Tesla 186. Tesla still doing amazing. Palantir 2258. Again, Jensen was on CBS yesterday. I wish I could play it, but CBS is really mean when it comes to playing their videos, and so they'll do a copyright strike on the channel. But basically, he said that NVIDIA is the future, AI is the future, and he didn't say anything that different that he's been saying for years, right? He just got to say it on CBS yesterday. PayPal earnings is tomorrow. I do think that the company buying back 7% of their float with its free cash flow, which amounts to about $5 billion, is exciting. And if they give any updates on that, we should see some more momentum there as well. So PayPal, I'll be streaming that live 8:15, 66.74 right now. I think a run to 70 isn't crazy, but then again, we'll see. stock is up a bit over the past, I think it's like up 10% over the past couple of weeks. So maybe that hurts it from going higher, right? Because it's already run up a little bit. Again, Amazon this week, AWS, if it's not slowing down, Amazon should be fine. Now, Coinbase, I think, is going to put up some ridiculous numbers. Where's Coinbase right now? Coinbase, DNA's up 17%. Okay, good for DNA. Not bad. DNA's back above $1. Nice. Good for DNA. Coinbase right here. Coinbase is down 5% because Bitcoin's down. I think Coinbase is going to print insane numbers. Bitcoin's up 60% over the past 3 months. Coinbase is one of the only platforms on the planet where you can buy and sell Bitcoin easily. Now, the thing about Coinbase is that they charge a fee to buy, they charge a fee to sell, and these mother effers charge a fee to transfer. Like I sold some Solana the other day, and they charged me $20 to transfer about $1,900 of Solana to my bank. And I was just like, that's crazy, dude. So if you're a Coinbase bull, you know, even if you hate the fees are part of the moat. Bitcoin's price, they get a percentage of the fee on Bitcoin's price, which means if Bitcoin goes up, their fees go up, right? Because it's a percentage of the price. The stock is up 7x since 2023, so maybe it's quote unquote baked in. But I think overall, if the numbers are good, it'll get a short-term pump. The thing is, if Bitcoin collapses back to like 55K, SoFi could put up $7 bajillion in net income. It doesn't matter. Bitcoin is the thesis, right? This thing has to go up. Wow, Bitcoin 6181 right now. Bitcoin's down 1%. So if Bitcoin doesn't go up, Coinbase is not going to go up. But if it does go up over the next couple of days going into earnings, Coinbase should do fine as well. So that's what we got in the context of SoFi, or in the context of Coinbase. Okay, where's SoFi right now? Where's SoFi? Are we still at $7? We're still stuck to 7. So there's not enough selling getting this thing below 7. Like from what I'm seeing, it hasn't touched $6.99 at all. Has it touched? No, literally. Look, the bottom is 7. It's like fighting to maintain $7. I feel like the market makers are playing with it a little bit. But let's see. Let's see where this thing goes in the next few hours, I guess. It's really tough, dude. Really tough to see this. Here's SoFi. We got TJ, good friend of the channel. He just posted some of the option gains that he has on SoFi. I thought these were supposed to be underwater today. LOL, SoFi needs to grow the tech side before a higher multiple can be justified. Happy wheeling and learning something from your boy. They are 2 to 3 quarters away, in my opinion. So his $9 covered call, look at that. He's up 86% on that. Not bad, dude. Wheeling can get really good when you have the right stock. You got to have the right stock, but he said SoFi wouldn't go above $9. He was playing with 1,250 contracts, which means he was playing with 1,250 times 100 shares, 125,000 shares. So he put 125,000 shares on the line that SoFi would not go to $9. There were people that bought those $9 calls expiring on March or May 3rd, which is 4 days away. SoFi is obviously not going to $9 by May 3rd. If it does, I mean, we're all going to make a lot of money, but that's probably not going to happen. So the guy who sold those calls is up 86% instead, and he'll be up another 14% in a few days as that contract expires. Worthless. Not bad. Not bad for SoFi. I mean, you should do an interview with a market maker. Yeah, I would love to. If there's any market makers in the audience or someone who knows a market maker, tell them to hit me up on Twitter. I would love to interview someone who works in the market making industry. That'd be a fun interview, actually. That'd be a fun podcast. SoFi 708, PayPal 6687, Amazon 180, Amazon up a little bit, Robinhood 1774. Robinhood retirement assets have hit $6 billion assets under custody. For those that didn't see that news last week, I think that's also a catalyst for why the street's going to get pretty excited. I think the Robinhood deposit numbers are going to be like redonkulous, dude. It's going to be insane. It's going to be insane. I think they're going to probably pull off a $10 billion deposit quarter. They did 3.4 and then 3.7 over the past 2 months. March numbers probably come back at 3 billion, and then trading volumes are going to be up. I mean, this thing's going to be crazy. Speaking of trading volumes, the other reason why trading volumes are important on Robinhood, look at Tesla last night. Tesla was up 5% last night, and people have to stop disrespecting the overnight trading on Robinhood. Everyone's like, oh, that's only on Robinhood. You guys don't understand. Like 437,000 shares were traded in an hour on Robinhood. Robinhood is becoming a major player overnight, and that honestly overtakes the pre-market action many times from the way I've compared the numbers for a lot of stocks. Maybe Tesla's like the pre-market's a bit higher, but it ends up being 30 to 40% of the pre-market volume. So it's a good indicator, is my point, for what happens into the pre-market. And so a lot of the people doubting the overnight action on Robinhood, this was like if you bought Tesla last night at 176, you're up already, right? If you had a Robinhood account, because it was up 5%. So we'll see how Tesla continues to trade, but this was exciting for what we got in the context of Robinhood. It's Robinhood 1775 right now, SoFi 711. SoFi recovering a little bit from that 701, but let's just see if it gets there. SoFi now in debt less than 10%. Yeah, it's rallying a little bit right now. There's some green candles, so we got some people buying up. We got some people buying up a little bit. DNA might be pumping. That's fine. Again, I don't know why DNA is pumping. Maybe there's some announcement or partnership. I still would not chase this thing, dude. I know it looks cheap at $1 and it's exciting. You're buying, 100 shares for $100. I would not chase this. I think fundamentally the company has a lot of issues and it's going to take time for them to recover. So SoFi right now 716, but DNA for those that got in at like 87 cents, congrats. You're up 20%. Not bad at all. SoFi right here 717. All right, getting a little bit of a green candle, a little bit of a pump. Maybe some toots are coming in. Maybe some momentum is happening, showing a little bit of a sign of life right here. We'll see if this can continue and if it could have any momentum. So we got SoFi right here. What else do we have right here? SoFi 716, that's up 9%, or that's down 9%. Bitcoin 62, going above 61. PayPal 66.92, 8 cents away from 67, and then Coinbase here 226. Tesla still maintaining that 10% gain. Did not expect Tesla to still be up 10%, but it's continuing to do that. Oh, where's Intel? Intel had a disgusting earnings last week. Wow, it's down another 2%. Absolutely incredible. Absolutely incredible, being down another 10%. DPZ, Domino's up 2%. Not bad. What other earnings did we have this week? Let me see. Earnings. Let's see what we had today. We had a couple other companies today. So today we had Domino's, SoFi. We had On Semiconductor. These guys, EPS, they beat by 3.85%. Revenue, they beat by 0.7%. Not bad. They are not a huge play in the semiconductor space, but they are a player. That's up 1.72%. And those are the main ones. On, SoFi, and then DPZ, Domino's. After hours today, we have MicroStrategy, Paramount, and those are the main ones. Paramount, we know, is probably getting bought out. Yum Brands, they own like KFC and a couple other companies, but MicroStrategy is going to be the big one today. Josh says, did you see 43% of small businesses were unable to pay rent in full in April? Highest delinquency rate since March 2021 per Bloomberg. I did not see that news. That's not the best news. We've seen a lot of these kind of credit event types of news in terms of delinquencies that have been picking up. I don't know how serious they really are at the end of the day, but they have been picking up. I'm more concerned about what's going on in Japan, and particularly what's happening with the Japanese yen, because I think that could trigger a more broader credit event if something were to occur. But we are seeing a little bit more of the credit events picking up across the entire country. What is your thesis on Siri for the long run? My thesis is Buffett. I don't own this stock, but there is no thesis other than Buffett. I posted about this last night, and some people are like, how do the guys have paid subscribers, or how many subscribers do they have? They have 34 million people that pay them per month. I think $10 a month for audio content. Howard Stern just interviewed Joe Biden. Howard Stern, one of the bigger names in the radio industry. Joe Biden went on his show. So, I mean, like, there's still people that use SiriusXM, especially in their car, to listen, even if all of us don't. I'm sure people in the chat listen to Sirius Radio. But that one is just Buffett. He's increased his position by 350%. DJT is up. DJT, wow. DJT is up 6%. Donald Trump, that one's up 44. $6 billion. He owns about 60% of it. So he owns a little bit over $3 billion of equity right now that he's not able to dump for another 4 months. But eventually he will be able to do that. Reddit is 4680. Reddit's up 3%. PayPal above 67. There we go. So we broke through that 66 level. Nice on PayPal. Amazon 180, Robin at 1772, Google 168, Google falling about 2%. And then Tesla still maintaining the pump of 10% today. Marathon, let's look at Marathon. Marathon, so CleanSpark's down 4%, CleanSpark's down 8%, Marathon's down 7%. All the crypto companies, MicroStrategy's down 3%. All of this is because Bitcoin is below 65, essentially. It was at 65 last week, so that's why they're down. Once that changes, those guys will probably go a little higher. But those are down. The Japanese yen hit levels last night, not seen in over 30 years. Yeah, that is why I'm a little concerned about what's going on with Japan. I'm still reading into it to try to get a more congruent thesis, but that's a little bit more concerning to me than some of the credit events that are happening. SoFi right now, 7.19. All right, picking up a little bit. It was at $7 literally 3 minutes ago. It's down 8% instead of being down 10%. How likely do you think it is that Palantir tanks on earnings? I'll give it a 30-70 chance. I think 70% we go up, 30% we go down. Any metric that the street doesn't like, they could tank it for that reason, given the stock is up so much. But 70% I think it goes up because the AI narrative seems to be intact. Google and Microsoft had great earnings. Amazon's going to have good earnings. Companies are willing to spend on AI. Palantir's got a ton of government deals over the past couple of months and some really high-level commercial deals like the one they did in Coles, Australia. And the healthcare partnership they did with Paraxel, which is the highest, or one of the largest contract research organizations or clinical research organizations in the country. So deal after deal, if it dips, I'll be really excited because I'll buy more. But I think more likely than not, Palantir does well. Chris says Japan is a major buyer of our debt. They kept rates unchanged, and that caused a huge sell-off of yen and buying of the dollar. That is correct. And that's why we're seeing a little bit of volatility right there in the context of the Japanese yen. PayPal again. I'll be live tomorrow, 8:15. I'll be live and we'll see what's going on with PayPal. Tomorrow we have Eli Lilly, Coca-Cola, McDonald's, and PayPal in the morning, and 3M. After hours, we have Amazon, Starbucks, AMD. Those three are big. And then Lemonade for anyone who's interested in that one as well. Oh, SMCI too. Tomorrow's a big day, dude. Tomorrow's a big day. And SMCI didn't give any of their preliminary numbers on earnings, on their preliminary earnings, which is why the street's a little scared. I am holding PayPal options. That's correct. I am holding some PayPal options. I think $90 by the end of the year is doable. So let's see. But that is what we're going to have to wait and see in terms of how it plays out. Let's pull this up right here. Wanted to show this as well. Yeah, let's pull this up right here. I think we should get an update on what's going on with rate cuts and the expectations of rate cuts. Here's Ed Yardeni. He's a really good macroeconomist who has seemingly predicted rate cuts pretty nicely over the past 2 years. Let's get his updates and thoughts on if we even have a chance to get one cut this year. The Fed is going to make their decision on Wednesday. That's correct. That's also going to be a big day for the markets.
Amount over the economy is that the economy might be heading towards stagflation. Our next guest says that the current economic scenario is nothing like the stagflationary environment of the late 1970s. For more on the markets ahead of the busy week that we've got this week with the earnings and the Fed's policy meeting, we want to bring in Ed Yardeni. He is the president of Yardeni Research. And Ed, this idea that it's not going to be just like the 1970s stagflation is a pretty good one on a Monday morning. Makes us feel better about this being a Monday. Explain.
Yeah, I want you to feel better. Look, I think last week when we got the GDP report, the knee-jerk reaction was that the data was stagflationary because real GDP was up only 1.6%. But a lot of that was because we imported more and we also saw less inventory accumulation. The final demand in the economy was still actually very, very strong. In addition, there was concerns about the pickup in inflation during the first quarter. I think some of it was kind of funky January, February effects, but we still do have a problem with the so-called super core inflation rate, which is the consumption deflator for services, excluding energy and excluding shelter. That's kind of stuck around 3.5% recently, but I think that's going to come down. One of the problems we have on the inflation side really is auto-related insurance and repairs have been a real problem on the inflation side. I don't know that there's much the Fed can do to repair your car or to offer you auto insurance, but that's bound to slow down. It's just been on fire for so long. So all in all, the economy is still doing well. On a year-over-year basis, we're still seeing a moderating trend in inflation. So I don't think this is stagflation at all.
You also don't think that the markets are going to continue to melt up, though, and that from your perspective.
Let's get to the live feed of CNBC and see some of the stuff they're saying. Here we go.
As you continue to grant a premium, even when it comes to a matter, and it disappointed the street on guidance, is because these companies convey that everything is in their control. If they miss, if they're light on guidance, it's because they've decided to invest heavily up front. It's a question of what the return on that's going to be. So I think that all that stuff's falling into place. You could still look at the chart of the S&P and say, it's just a little bit of a reflex bounce. You still haven't gotten over the 50-day. This is where bounces tend to peter out, and we have to deal with what the Fed says, the two-sided risks, and where yields have gotten to. I still think the big question is we have a high metabolism economy right now. That means better growth than expected, a little bit higher inflation than we thought, And companies can make hay with that, and they can, invest against that, and they're still hiring, and that's a good thing. Question is, do we think it raises the risks if the Fed is really patient, if we keep rates up here on the short end? Because you are seeing some wear and tear, I think, on the consumer, not in the overall, but on parts of the consumer. If you look at equal weighted consumer cyclical stocks relative to industrials in particular, they're at the lows. And it's because the industrials is where you have a lot of the big mega themes people are excited about. And consumer, there's wear and tear there.
I think the question is, a little bit of sticky inflation is okay if it's backed by a strong economy. That's what the stock market is telling you.
Exactly.
But if it's backed by a weakening economy, then you start talking about stagflation, and that's worrisome.
You don't necessarily want inflation to be more than half of your nominal growth. Right? I mean, if you think about it that way, if you had 5% nominal growth, it's 2.5 inflation, 2.5 real, that's fine. I think in general, the market starts to worry if it's more inflation. And I think stagflation is probably overused, and people think of it as double digit, inflation and nominal and real growth is kind of negligible alongside of it. But nonetheless, to your point, you don't want it to be mostly about sticky prices. I think you're still going to have a contingent out there saying, look, the Fed's being too cute here. We're under 3. Historically, under 3 is fine for the markets, for the economy. You don't necessarily have to, speed your way to the 2% target, but you don't want to backslide too much against that.
I was taken by the comments from the Capital One chief. Consumer still a source of strength, labor market's resilient, bank balance is still above pre-pandemic, rising incomes, debt manageable. I mean, that's from Capital One. Well, we would worry about the lower cohort.
Well, we would worry about it. They want to spin it as, in aggregate, the entire pool of borrowers looks okay. There is this vintage of auto loans and of credit card balances that have become a problem. And maybe you've already realized that. Maybe they've already soured to the degree they're going to sour. We're just back to pre-pandemic levels. So I'm not talking about the consumer is going to peter out. But it is something in terms of you look at where the strength is relatively and where you sort of say, what's the risk of staying at these rates and kind of betting that you can, keep unemployment in check along the way. That's where the risk is.
Well, I think
Oh boy. All right. Let's do one last check on the markets and then I'll get you guys out of here. I know this was a longer stream. Thank you everybody for joining. Really means a lot. If you are new to the channel, we do a market open every single day. And I'm sorry the excitement levels weren't amazing today. It's because we had some crappy price action, but usually we keep the energy high, even if it's a tough red day. It's just, I think we all expected SoFi to be a little bit better. 713 right now, down 9.3%. DJT's up 10%. Reddit's up 3%. Domino's is up 3%. On Semiconductor up 1.79%. Bitcoin up a little bit right now, 62,156. PayPal just below 67, 66.80. Google 168. Robinhood 1784. Meta 435. Tesla maintaining the 11% pump. It is not going away, 186. And then Palantir here, 2271. Apple as well, 175 on the day. Big news. SoFi down 9%. We'll see how it plays out. And we've got, I guess, the next couple of weeks to see if this price action reverses, which I think it's oversold and it will. I don't think a triple beat warrants being down 10%, but I don't know how many dip buyers are ready to step in as it's down right now. So we will see. Amit, how big is your SoFi position compared to your overall portfolio? Relatively small. It's $5,000 in options. And those options right now today are worth $4,500. So it's not like I had a huge position that I was excited about. But I thought, we could get a pump to $9 and those options could print. Didn't happen. And it is what it is. Last time we made 1,200 on SoFi options. I did the same thing I did last time. I bought some spreads. I put 4,200. We exited at 6,000. So we made, we exited at 5,400. So we made like $1,200. And that was great. I thought we could repeat it this time. But SoFi did worse this time than last time, even though they had a better earnings theoretically than last time. So it is what it is. A word of the day. Let's get to word of the day. Thank you, everybody, for being here. Oh, I think I know this word. Smorgasbord.
Smorgasbord.
Yeah, I know this one. An extensive array or variety. I've heard this word somewhere. The music festival offered a smorgasbord of musical genres. She was impressed by the smorgasbord of colors available in the paint aisle at the local hardware store. I am impressed by the smorgasbord of beats that SoFi did on the top and bottom line, and the lack of price action that we saw when it comes to SoFi. All right, I'll be back 3:45 p.m. We've got earnings today for MicroStrategy. That'll be a big one, so we'll look at that. That'll be the big one after hours. Tomorrow, PayPal will be here in the morning, and then tomorrow, Amazon. So big week in earnings. Got a lot of stuff to discuss. and we'll keep going from there. Diego, what do you think the catalyst for SoFi will be moving forward? In my opinion, that B2B tech side of the business has to pick up, and Anthony Noto has to sound like he actually cares about the company on earnings. If he can do those two things, maybe this thing can run up. But until then, it's going to be in a little bit of a tough situation. All right, that's it. Thank you, everybody, for joining. Daily Pound episode will be out in a few hours. I appreciate everyone. It means so much to me. You spent your morning with me. Again, I do not take it for granted. It means the absolute world to me. I'm sorry SoFi didn't do the best, but we're just going to have to see how it plays out over the coming weeks and months, and hopefully we get a little bounce, given it seems like it's oversold. Thank you, everybody. I'll see you guys at 3:45 p.m. later today. Bye, everyone. Have a good one.